Okay, everyone, welcome to the SaMMF OTC Markets Workshop. We're very happy for all of you to join us. We have 4 great papers today. You can see the program on your screen. We'll also put a link to the program in the chat. So just quickly before I hand it off to Patrick, the format is each talk will take 1 hour. There'll be a 35-minute presentation followed by a 10-minute discussion, and then 15 minutes for open Q&A from panelists and attendees at the end. Since the talks are only 35 minutes, we ask you to please, feel free to ask questions. So panelists, you could unmute, freely and ask your questions. Audience members, if you want to ask a question, you could do so through the Zoom Q&A feature. Since the talk's only 35 minutes, we ask that you try to keep those to mostly clarifying questions, interpreted, I guess, somewhat broadly. The last thing is the workshop is being recorded, and then we'll post the recording on our YouTube page. So without further ado, I will stop sharing my slides and I'll hand it off to Patrick, which will be our first presenter.
Great, can you hear me okay?
Yep.
Great, thank you to the organizers. I'm very happy to kick this workshop off. So this is work that my brother and I started when we were both PhD students at LSE. Now I'm at the Toulouse School of Economics, and Jamie is on the job market this year, but with a different paper. This isn't his job market paper. So we use Bank of England data, and we both have affiliations there, but obviously the usual disclaimer applies. Now, the motivation for this should hopefully be relatively familiar to you, in the sense that we're talking about the interbank network. And we mean this more broadly than, say, overnight lending, which is sometimes called interbank lending. We mean direct interconnections between banks through lendings or derivatives. So any direct interconnection between banks. And there's a trade-off there where we're familiar with the idea of these direct interconnections creating counterparty risk, which can aggregate up into systemic risk. But at the same time, they do something. They create some surplus, either liquidity provision or hedging or something that is valuable. And this is a quotation from Janet Yellen, which talks specifically about managing this trade-off. So in order to allow the good bits whilst limiting the bad bits. And ultimately, our research question is about exactly that. How do we design and test regulation that can manage this trade-off better? And these are the kind of sub-questions that go into it, which I won't go through in detail, given that in 35 minutes, hopefully you'll get the answers to it. But ultimately, we have something new to say about each of these sub-questions, something new to say about how the network affects systemic risk, and then we build up to some novel proposals, tweaks to existing regulation that would manage this trade-off better. Now, this, as you'll have got from the title, is a structural estimation with some novel data with a model and then estimation and then some counterfactual. So it's all quite interrelated. And given that, as Zach said, this is a relatively short presentation, I'm going to subject you to this slide, which is a 1-slide overview of what we do. It's a little bit longer than I would usually do if the presentation were longer. But I'm eager to give you an idea of how we estimate it and how we use it in counterfactuals, to bear that in mind, for example, when I present the model in detail. Now, the starting point is going to be Bank of England data for a small subset of banks, 18 major banks, on their pairwise aggregate exposures. So, for example, Goldman Sachs reports what it would lose, its exposure at default, if JP Morgan were to default tomorrow. And it does it in various buckets according to whether it's lending or derivatives, some maturity profile, currency profile we see. But the main advantage of the data is its aggregate. So there are a lot of papers, for example, that use overnight lending or that use CDS exposures. This is the best measure that we're aware of in the literature that is about aggregate exposures. So someone once talked to me about this being a glimpse of the iceberg beneath the surface when we're used to instrument-specific views of what is above the surface. And what we learned from this is these are only the 18 biggest global banks. So this is the core of the network. I'm going to show you a network diagram, and it is dense. So this is a dense core that we're seeking to model. The other empirical fact I'm going to show you is concentration. So this is going to be a simple Herschendal index over time, is increasing. So basically, the bigger links are getting relatively bigger compared to the smaller links. And we're going to come back to that as an important thing. Based on this, we then have a model with two parts. The first is a model of the outcome on the network, and this is a spatial autoregression, the SAR, which is, it's a network empirical model which is used in geographic models where the network measures geographic proximity, or in peer effects in classrooms, but also in financial settings. So there isn't much notation on this slide, but the ones to know are the network is C, so a given exposure Cij is the exposure of bank I to bank J, and P is the default risk of the bank I. So this spatial autoregression relates PI to its holdings Cij. And the way these models work is there's a parameter that governs network spillovers. When it's big, spillovers are big. When it's small, spillovers are small. And the tweak we make is that we allow this network spillover to be pairwise. It varies heterogeneously amongst pairs. Now, there are various reasons why you might expect this to be the case. Risk sharing, for example. A given exposure to bank J depends on the characteristics of bank J and how they relate to it. But this is going to be a parameter that we hold fixed and that we estimate, but it has motivations like risk. We then have how this network C is formed. Now, the demand side of this is going to be relatively straightforward. The supply side is effectively going to be quantity competition. So this is effectively a core-no game, but where the cost that bank I incurs when it has an exposure depends on its default risk. The default risk, as per the first part of the model, depends on its exposures. So it's introducing a nonlinear cost function by the impact on its default risk. There's also going to be a role for regulation here. Now, this is simply a tractable way of modeling how trade occurs along this network. And it also gets at the heart of some of the complaints about capital regulation. So, for example, banks say that increased capital regulation increases their costs, and we're going to be able to get at that. This model is built to then be taken to the data, where the key things that we're trying to estimate are these network spillover effects, which vary between pairs. Now, this quantity competition model and the relationship with cost means that equilibrium network links depend on the default risk of the participants, but also depend on this network spillover parameter. So if the network spillover parameter is high, then a bank is relatively risky to link with. That then impacts the equilibrium link between them. And this is going to be important in estimation. Basically, we're seeking to get at these gammas, which are these parameters, these network spillovers we want to estimate. And we do so via the joint distribution of the network, CDS premia, which we use as a proxy for default risk, regulation, and some bank fundamentals. Now, there are two important things I want to tell you about this, two benefits to this. The first is that identifying network spillovers only from outcomes, so from risk measures in this case, is difficult. Why? Because there isn't much of that kind of data, right? We have N banks, so the vector of default risks that we have is only N by T. So to identify a whole load of network spillover parameters by only looking at outcomes on default risk means that we use up a lot of degrees of freedom quickly. The advantage of also fitting network data is this network data is not N by T, but it's N squared by T. We have many more observations. And we can infer something about these network spillovers from the equilibrium links. So the way that I sometimes think about this is it's difficult, for example, to look at peer effects in the classroom by looking at how test scores, how outcomes are correlated. Here, we're not only inferring peer effects from looking at how outcomes are correlated, but we also look at where the pupils sit in the classroom. So we look at how the pupils distribute themselves, which is the network. So we infer something about the spillovers from the network, the model implied network that we get to observe now. And because of this structure, we're able to include a much broader range of fixed effects to identify these parameters of interest more clearly. Finally, once we have this estimated model, we're able to run counterfactuals where we model, for example, the social planner's choice and some changes to regulation. Now, what is the social planner maximizing here? It's pretty clear that the social planner's objective is not to maximize the surplus solely of Goldman Sachs and of JP Morgan. One of the issues with papers that look at the impact of capital regulation on market functioning, for example, is that we can sometimes look and see that capital regulation harms market functioning, but we can't say anything about the objective of capital regulation, which is to make banks safer. Now here, capital regulation is going to have an impact on bank default risk. So we're able to have a more holistic measure of both default risk, of the impact of capital regulation. The way we get at this is by saying, let's assume the total surplus in the economy is a function not just of bank surplus, but also of real world surplus, which we're assuming is decreasing in the risk of banks. So we're going to be looking for regulatory changes that increase both the surplus and decrease bank default risk. That we can conclude is a welfare improvement. If something decreases bank surplus and bank default risk, then without knowing the relationship between bank default risk and the real economy, which is very difficult to model, then we can't. So this hopefully gives you an overview of where we're going with this. The simplicity in the model allows us to include a broad range of fixed effects and this key cost relationship with its default risk, which we then take to data and estimate it and allow us to model counterfactuals. Now, again, I'm going to come back to this slide at the end. These are the questions we had beforehand. These are our answers. But ultimately, we find there is heterogeneity in these network spillover parameters. These network spillovers have a broad range of implications, and we can design some regulation that, because of this heterogeneity, would increase bank surplus while simultaneously making them safer. In a way that no matter what you think about the appropriate level, for example, of capital regulation, we should agree improves aggregate outcomes. Okay, so that's the high-level pitch. Straight then into the substance. So this is Bank of England data, as I said, on counterparty exposures. It covers derivatives, debt, securities lending, repo. It's relatively small N&T. So it's the 18 major banks from 2011 to 2018, captured initially every 6 months and then quarterly. So whilst N and T are both small, the number of links that we observe is N times N minus 1 times T is a reasonable sample. Now, there are some issues with this data, which we take seriously in the paper, but I'm not going to dwell on too much in terms of its coverage, for example, which banks are missing, which bits we see completely, which bits we see less completely. So they're important, but I'm not going to focus on them too much. We then have a set of risk-neutral probabilities of default, which comes straight from CDS. This then is what the network looks like. So the size of the circle is the total outgoings of the node, so the total exposures held or proportional to that. Now, links go both ways, right? I can have an exposure to Bank J and Bank J can have an exposure to me. They do not net off unless they're in a very similar type of derivative product. So links can go both ways. We don't show that here. That graph would be too busy. So a solid line is simply the biggest link in either direction. A dashed line indicates that there is no link in the other direction. So what do we see from here? We see it's dense. There's not much heterogeneity in the presence of links, but there is heterogeneity in the size of links and in aggregate outgoings. Here then is a measure of HHI. So this is concentration within this network. How big are the big links relative to the small links? And we plot it here from 2014 to 2018, and you'll see it's gone up over time. Now we plot it here against average capital requirements, which have gone up in a way that looks similar. Now, obviously, I'm not asking you to draw any causal conclusions from a graph like this, but the model is going to deliver a relationship between concentration and capital requirements, and we're going to use it in estimation. So I'll come back to this graph to argue that there is a relationship between the two. So then, the model I've given you an overview of already. The notation is C and P, and we have these three parts: default risk, and then demand and supply. This is a simple spatial autoregression. So on the left, we have default risk. On the right, we have fundamentals and network spillovers. Gamma then is
Patrick, can I just ask, if you go back to your concentration, what was that concentration of? I just missed it.
Yeah, so this is the concentration within iBanks. So basically, this takes the exposures of bank I to all the n-1 other banks. It calculates a market share, so the proportion of its exposure of its aggregate outgoings that is to a particular bank, and squares them. So it's like in IO, the HHI index is a measure of concentration. Basically, bigger links, because of the convexity of the square, would be high. So it indicates that within banks, their bigger exposures have gotten bigger than their smaller exposures. Okay, so this is a spatial autoregression where gamma is the network spillover parameter. And if you look at the partial effects, then you'll see that the impact of being connected to a riskier counterparty depends on the network spillover and the size of my exposure to that. We adapt this in a simple way to account for our setting in two ways. The first thing is we allow the network spillover parameter to be heterogeneous. So instead of a scalar gamma, it's a matrix cap gamma, such that the impact of a given default risk at which you are exposed depends not just on the size of your exposure, but on the intensity of that network spillover parameter. So what we call an inherently safe link is if gamma ij is low. So for example, if fundamentals are less positively correlated, risk sharing might imply that gamma ij is low. So in the paper, we have a more primitive model, basically a distance to default model that we simulate, and we show that it implies that risk sharing implies heterogeneous network spillovers. So it shouldn't be contentious to say that there are network spillovers. The other thing is we don't want to limit the model to say that exposures between banks are necessarily bad for default risk, increased default risk. Why? Because we know that banks, we have there's a lot of literature that says that banks can exchange debt contracts or derivative contracts in a way that can improve their default risk through hedging. The way we account for that is simply by introducing this omega term, which depends on my total exposures. So let's then look at the partial impact of having an exposure on the person holding the exposure, bank I. That depends on the size of this hedging parameter. It depends on the risk of the person to whom I am connected, and it depends on the intensity of the network spin. So in some sense, one of the appealing features of this model is that it is a standard network econometric model, network empirical model. So we're able to build on that literature in a way that I'll try and make clear later. But it also imposes restrictions. You know, this linearity, for example, ignores things like too big to fail. All that really features in here is counterparty risk. Supply then, so demand and supply, I said was going to be quantity competition. It's a chrono model where we make a complication through the cost function. So bank I has an endowment of potential exposures. So if this were debt.
Patrick, can I ask you just one clarifying question? Sorry,
Yeah,
can we go
please
back
ahead.
one slide?
Yeah.
So what kind of assumptions are going on in the background to make sure that like this PT is kind of well defined in the sense that it's uniquely defined?
Yeah, so I mean, to solve PT, you take this term with the other PT over to the left-hand side. You then invert the identity matrix minus gamma times C. And so the uniqueness and the well-defined depends on whether that matrix is invertible. Now, in practice, that's going to place a restriction on the size of the network spillovers so that that isn't explosive.
I see. So it's ruling out the possibility that if everybody else defaulted, I would have to default, but if nobody else defaults, I don't need to default.
Exactly. So this is what I mean by it being a linear model. It's linear in the feeds. It ignores non-linearity.
Okay, thanks. Sorry.
Patrick, a similar question.
Yes, go ahead.
So to make sure that there is a unique solution to this fixed point, do you also put restriction on the C? So C, as I understand, is going to be endogenous. So do you restrict it to a set or something?
Yeah, so cool. That's a good question that we haven't thought of. I mean, you're right that if C, yeah, for a given parameter vector, if C was too high, that system would be explosive. I don't have a good answer to that question. All I can say is that so the system doesn't explode when we solve it. So there must be something in the network formation game that means that they don't set C such that it explodes, but I don't have a very clear answer for that now. But in practice, it's easy to test, right? If you try to invert the matrix, it doesn't work, it doesn't happen. But I'm not immediately clear what process it is in the network formation game that does that.
So just one thing is that I think the technical constraint is that the gamma C has to have eigenvalues of smaller than 1. That's the constraint for not exploding, I could say.
Thank you. Yes, yes, that's right.
I mean, there's another issue which is in the first stage that you're going to go through now. It looks like agents have to form expectation about what would happen if they set a C that moves you in this region that you call explosive. And those expectations will, I mean, needs to be specified to solve the game.
So, I mean, yes, I would need to think about that. So, I mean, in chrono competition, people form conjectures about what the other C's are going to be, and they are right in equilibrium. Now, you're right that there is some relationship between the choice of C and the fact it doesn't explode, which I don't have pinned down yet in my head. So I'll need to think more about why it is that the system never explodes. But when we solve it, it doesn't. Yeah, this is clearly something we need to pin down in a little bit more detail. So they're choosing whom to supply this exposure. They receive an interest rate which is going to be pinned down in equilibrium from the demand side, and they pay a per unit cost. The per unit cost is basically the equity that they need to raise in order to support this exposure. So this is where regulation comes in. The capital regulation, lambda, is something that is going to shift this cost function. It then depends on the cost of each unit of equity that I need to raise. And the cost of equity we parameterize simply as a linear function of my default risk. So taking other P's as given, what this means is that the change in my costs when I lend to someone, when I form an exposure to someone, depends on how much riskier it makes me. So this embeds two things that we think about. Number one, why do banks dislike capital regulation? Because they say it makes it more costly for them. We embed that directly. Number two, we have a belief that banks become too risky. But why do banks care about becoming too risky? It affects their costs of funding themselves. And that is also in there. So this is basically changing the bank's management of its default risk into a non-linear cost function. Why do banks want to manage their default risk? In order to manage their costs of funding themselves. So what this means is that the marginal cost of taking on an exposure is pairwise heterogeneous through this gamma ij. So high gamma ij means an inherently risky link, means it increases my marginal cost by more if I lend to them. So inherently safe links are cheap, inherently risky links are expensive. Similarly, lending to someone who is risky is more expensive. So then we have a straightforward first order condition equating the marginal benefit to this marginal cost. I pay a per unit cost and that per unit cost changes. And there's an outside option. Demand then is simply to pin down the interest rate where it's linear demand with differentiated products. So how should you think about this? This effectively creates reduced form motives to trade via the intercept here. So we say the bank J has some technology for which it requires inputs, exposures, which are provided by bank I. There's a cross price effect, which basically indicates that if there are banks who supply similar things to bank I, then competition means that the equilibrium interest rate is there. So this is very simple. It's downward sloping linear demand with differentiated products. So, you know, the motive for trade, for example, in some OTC models is randomly occurring liquidity shocks that are effectively taken as given. Here, the thing we take given is we say people need to trade. There is some motive to trade that we're effectively going to capture via these fixed effects and capture them empirically and leave constant. And that's as much as I wanted to tell you about the model. So it's imperfect competition with non-linear cost function. It's a tractable way of characterizing how, for example, the treasury function of a bank determines exposures. Exposures allow me to earn some return, but they also affect my costs. So you can think about the agency as being the treasury function managing the exposures across all the divisions. Now, there are three inefficiencies. There is a network externality, which means that bank I does not fully internalize the impact on other banks of its exposures decisions. Because risk, the network risk, is then mapped into cost, this is also a cost externality. Bank I does not fully internalize that its decisions make other banks costlier. There is market power, and then one product of this market power is that cost allocations can be inefficient. So costly links have slightly more allocated to them than a social planner would allocate. Now, these inefficiencies act in different ways on how the social planner would vary the equilibrium network. So cost externalities means that the decentralized network is too big. Market power means that the decentralized network is too small. The inefficient cost allocations aren't about size, but are about the relative distribution of a given network. Simple comparative statics, which hopefully won't surprise you given what I've set up. The equilibrium network link from I to J is decreasing in the network spillover. So safe links are big links, and is then decreasing in these fundamentals, where high fundamentals mean bad default risk outcomes.
Patrick, you have 7 minutes.
Thank you. So if we look at this density then, why is this link here particularly big? The model has various explanations for that. It could be the fixed effects in the technology. So these are banks who happen to simply supply things that the other person needs. It could be because the network spillover is low. It could be because this bank, the recipient, is safe and therefore cheap to supply, or it could be because this bank, the sender, the holder of the exposure, is safe and therefore finds it cheap to supply. So identification then is going to come from the joint distribution over time of default risk, network structure, bank fundamentals, and regulation in a way that allows us to unpick these network spillover parameters from these fixed effects that are motives for trade that we effectively hold. So estimation, I'll be very quick on. If you look only at the outcomes, so you look at the default risk, one of the difficulties with that form of network econometrics is that the network itself is endogenous. Now, the advantage of having a model of network formation is it gives us instruments for the network that we can use to understand the impact of the network spillover on default risk. Separately then, there's the big advantage that I told you up front, that because equilibrium network links are a function of these network spillovers, we can infer something about them from the network structure. And that is going to be this graph again. So there are banks out there. So bank I is choosing who to lend to. There is a bank for whom its network spillover parameter is low. That is a relatively safe link. There's a bank for whom its network spillover parameter is big. That is a relatively risky link. That then maps directly into cost. The safe bank is cheap to supply. The risky bank is expensive to supply. Capital regulation is a multiplicative shock to these costs. That came from the parameterization of the cost chart, which means the absolute increase in cost is bigger for the risky, costly links. Those links in equilibrium are the small links. So what this effectively means is capital regulation increases the cost of risky links, which are small links, relative to safer, bigger links, which is why it leads to this concentration. What that means is that in estimation, when we see which banks bank I lends relatively more to over time, that allows us to separately identify the network spillover from, for example, the fixed effects that we hold fixed, which are about the trading. So the point of the model is that it allows for this identification of these parameters. Now, in the short amount of time that I have left, I'm going to run through a couple of the counterfactuals. So the results imply that there is a large amount of variation in this network spillover parameter. What does this mean? Coming back to this set of questions. How can we answer these? So, number one, which banks are systemically important? When we have a default risk process like this, how do we know which bank is most important for aggregate outcomes? One of these is eigenvector centrality, which is simply a ranking based on a manipulation of the network. Now, typically, this is done on the raw network. When the spillover parameter is scalar, then it doesn't matter for this ranking, right? It affects each of them equally. If, however, the spillover parameter is heterogeneous, then a ranking based solely on the raw network gives differing outcomes to the ranking based on the weighted network by spillovers, which is what you want when you're thinking about P. So when people look at the eigenvector centrality ranking on the raw network, they're missing something about spillovers. And what they're missing is not random, because what I've argued is that the bigger links are more likely to be safe. So in equilibrium Y is a big link safe. It's safe because the network spillover is smaller, which means that you overstate the role in risk propagation of big links. They are big because they are relatively safe. And we can show how the ranking changes over time. Sorry, not changes over time, varies across banks and varies when we do it based on the raw network, which are the blacks, and based on our weighted network, which are the whites. So this looks like the most systemically important bank, bank 18, whereas actually it's big because it's relatively safe. You can think about this as omitted variable bias. There's an omitted variable when you look at the ranking of the unweighted network. In the last 2 minutes then, I'll talk about this social planet. So here on the y-axis, I have the mean default risk. Here on the x-axis, I have interbank surplus. This is the actual outcome here, this plus sign. Now, what we ask is, can we rearrange the network, so picking links, to maximize surplus whilst holding default risk constant? That's this term to the east. Or to minimize default risk whilst holding interbank surplus constant, which is this term to the south. Any term, any point in the green area is then a welfare improvement. It improves surplus and it makes banks safer, which improves real world surplus. Any point over here is obviously worse. Any point here, we can't say anything about it. It would depend on the mapping from bank default risk to real world outcomes, which we have no hope of measuring. So in some sense, we gain something by looking for things where we know that surplus will improve. But any outcome in this area to the southwest, we can't say anything about. Now, if you look at how the social planner varies things in this green area, it concentrates, it loads slightly more on the safer links, the ones with low network spillover, than on the other ones. So is there regulation that we can do to help that? Zach, I'll just explain this slide and then finish if that's okay. I appreciate I'm close to the end of time. So let's take, for example, a cap on your biggest link, which is a cap that has been proposed. Firstly, this is relatively ineffective because all it means is that the network re-equilibrates elsewhere. If I can't lend to my best customer as much, I lend to someone else. So the impact on default risk is limited. Furthermore, those big links that you're capping may be the safe ones. They are big because they are safe. The alternative we propose is a cap on aggregate supply. So to say to Goldman Sachs, add up all your exposures and reduce that aggregation. You can allocate them however you see fit. And this improves outcomes by decreasing bank default risk because they can't simply re-equilibrate to avoid it. And they end up focusing more on the safer, low network spillover links. Similarly, you can do something by tweaking capital requirements in order to promote links that have low network spillovers. So that is, I think, as much of a summary as I'm able to give. I'm sorry I don't have time to link this into the many excellent papers about this. You know, the advantage, innovation, if you like, in what we do is the structural estimation of both default risk and network formation, and to look for regulation that improves both of those outcomes.
All right. Thanks, Patrick.
So thank you for your time, and I look forward to Yinan's discussion and then the discussion.
Great. Thank you. Our discussant is Yinan Su.
All right, thanks for having me. This is Yinan Su. I'm from Johns Hopkins Carey, and I'm very honored to discuss this paper here. I remember that I was impressed when that first came out, when Patrick was on the job market, and it's great to read that again with this updated version. All right, so first, let me give a kind of a brief summary here. Right. So the interbank network is made up of pairwise tradings. So I'm thinking about this pairwise tradings in the sense that each pair IJ is trading a standalone product, right? Each pair IJ has a product, each pair IJ has a price, an interest rate. So in this sense, it's not quite exactly like borrowing, lending, or trade. The bank, it's like not quite flow in the sense that the buyer cannot kind of aggregate up the flow and pass it along. So it's really like the buyer demands to trade because I have a technology that allows me to put all this input together, and that is the reason why I want to buy them, right? And for the supplier side, the supplier has market power, it's kernel competition. They supply, they choose both quantity and price depending on the buyer's demand curve, right? So in this sense, up to here, I can think this is also a production network, right? So what makes it really the banking network part is this part, right? It says the supplier's cost depends on its default risk, right? So the supplier's cost to how much to supply depends on its default risk. The higher the risk, the higher the funding cost. And importantly, this default risk has the spatial autoregression structure, meaning my default risk depends on who are my neighbors, who am I connected to, and my default risk depends on my neighbor's default risk. So in the supplier's question, in the supplier's problem, when I'm thinking how much to supply, I need to think about how that changes my default risk. But of course, there is externality embedded in this part. The concern is not going to complete. I'm not going to think about how it affects all my neighbors' default risk. So that is kind of the spillover externality effect. And that is the root cause of one of the inefficiencies that will later appear. Right. So I think overall, the model is very rich in terms of number of parameters. It has high degrees of freedom. Although later on in the estimation part, some of the dimensionality is reduced with some parameter assumptions. But overall, this is a very rich model. The model is built with identification, with estimation in mind. It is structurally estimated with this novel data on pairwise exposures. So you have n squared data every period. And also I have a cross-sectional data on the default risk every period as well. So that's the two data part that facilitates the estimation. Overall, my summary is kind of short. There is an extensive analysis, lots of interesting results, and also it's a novel and valuable data, as well as a new empirical methods, right? So more things than I could summarize here, right? So let me jump into my comments. So my first comment is more on kind of my exposition. I kind of want to say, I hope there were further clarify which analysis leads to which results. Right? So I give two examples here. I will talk about two results here. I think the results are very interesting. They make sense in a rough sense, but I kind of want to think about in more detail, why do we have this kind of result? And in particular, I want to think about, should I understand this result from the theoretical modeling part, or should I think about understand this result as a quantitative measurement, as a estimation result, right? So my hope, my ideal hope would be it is well defined from a theoretical model, and then the estimation part is to measure that. For example, inefficiency, right? The estimation is to measure a quantity, how much is the inefficiency. Right now, my impression is a little bit like, I don't know so much about the theoretical result, but I have to jump to the structural estimation and just believe the quantitative measurement, right? So that is a little bit my impression here, right? So the first result I want to think about is the inefficiency result, right? But I want to, from a theoretical applied theory perspective, I want to really think about what are the frictions that are the root cause of this inefficiency, right? So in the paper at very first, it says there are 3 potential sources of inefficiency: network externality. I sort of understand market power from the supplier. I sort of understand maybe the third one, the naming is a little bit tautology. It's inefficiency is a source of inefficiency. So maybe the naming is a little bit tautology. But then I read the paper, and in the empirical part, I just not very clear what exactly are we measuring when we are talking about, okay, this one is the primary source, this one is not the primary source, right? So what are we exactly measuring when talking about this empirical result? So here is in the empirical part, again, these 3 externalities. Maybe the first one reads like, it's like some statistic of the parameters, right? The extent of network externality depends on the size of gamma I. The extent of market power depends on the size of theta ij, and inefficiency depends on the dispersion of gamma ij. So I sort of understand why we have this kind of relationship, but the ideal way, I would think the really ideal way is I have an expression that says a network externality equals to an expression of gamma ij. So there is a theoretical expression, I can understand where that comes from. And then I have an estimation part that estimates that expression, measures that quantity, right? So I hope I could have that. But of course, I understand that might be hard to do because this model is very rich. It is built with estimation in mind. So maybe is it possible that we have a stripped down version where we can show the mechanism clearly first, and then we have a fuller model that we estimate where we can quantify these quantities, right? So I just want to see a quantity of all these different inefficiencies, right? All right, the second result I want to look at, this one doesn't appear very much during the talk, but it appears prominently in the paper, right? So I think this is a very interesting result. The result says when bank fundamentals are already bad, the contagion effect dominates the hedging effect, and as a result, network increases systemic risk, and vice versa, right? So I think this is very interesting. This is telling me when the fundamentals are already bad, you have a network, it makes things even worse. You increase systemic risk, right? And then I just want to read how exactly that happens. The evidence where this argument is supported is mainly this picture. However, this picture is a time series chart, right? So in the time series chart, it says, okay, when the bank fundamentals are bad earlier in the sample here, the effect on default risk is positive, right? And then later in the sample, the fundamentals become better, and the network's effect on default risk is negative, right? So I just kind of feel by just looking at the empirical evidence, it is a little bit too quick to conclude this conclusion by looking at this picture, right? Because this is a time series chart. What if some other things get changed, right? What if it is because a network shape changed between the first half and the second half of the sample period, right? So I'm just curious. I'm still have some curiosity that is not satisfied about why do we have this result? Can I really think about the channel? Because I think this is very interesting here. It tells me how and why the network can sometimes exacerbate the bad fundamentals. So the fundamentals are already bad, and the network makes it even worse, right? So I want to kind of understand that so that I understand the mechanism, and also that helps me with my interpretation of the quantitative measurements, right? So
And then maybe take 30 seconds, a minute to wrap up.
Alrighty. So very quickly, my second comment is on the concept of systemic risk. So here we use network to talk about systemic risk, but is systemic risk just the average of every bank's default risk, right? So is the average of individual bank default just the systemic risk, or systemic risk is about the risk some extraordinary event that happens across the system, right? So supposedly this two is slightly two different concepts, and I know this paper emphasized the difference between these two, right? Is the average of everyday risk the same as the risk of some extraordinary network-wide effect? And I was planning to exploit this chance to shed a little bit light on this with my paper, Interbank Runs, that uses network as a modeling tool to paint a picture about how small and local shocks can trigger a large and system-wide liquidity crunch. So it's not exactly as the contagion mechanism that's going on in this paper and many other paper with the spatial autoregression part. So here I have the amplification effect so that small and local shocks can eventually lead to a system-wide event once it crosses a critical mass, right? So that should wrap up my discussion here. I have some technical details that I can just send to Patrick. And Patrick has been very helpful for me to help prepare this discussion already. So it's very appreciated.
All right, thanks, Yanan. So now we'll go to the open Q&A discussion. So panelists, feel free to unmute and ask questions. If you're an attendee, if you want to ask your question live, you can use the raised hand feature, or I'll try to relay some of the questions in the Q&A. So maybe to start, we'll go to a question we have in the Q&A. I'll ask your question. So Patrick, I'll ask, how can we think about the effect of network structure and spillovers on bailout probabilities and too big to fail within this framework?
Yeah, so the short answer is it doesn't really fit within the framework. So, you know, one of the things that we call technology as one of the fixed effects in the demand side might be that people like having people holding exposures in them because it makes them too big to fail. Now, the problem with that is not good surplus, if you like. That is not the kind of surplus that we should be protecting. So as to the question is too big to fail in the model, it doesn't feature in there. For example, the default risk process, the spatial autoregression doesn't capture too big to fail very well. You would need, for example, to have your incoming exposures, the exposures that other people holding you having a direct impact. It doesn't fit. There's then a second element, which is fine. It's not in the model, but does the fact that there were time varying too big to fail considerations affect your identification? Because the rules on too big to fail changed, right? And does that affect things? And that is discussed in the paper and partly swept up by allowing these network spillovers to vary over time in a way that should speed this up. So the short answer is it doesn't feature. It's a model of counterparty risk directly.
Can I ask you a question? It was actually a clarifying question, but I deferred because of the time constraint. So Yinan also had a slide on that. There are three sources of inefficiency: the network externality, market power, and inefficient cost allocation. So as I understand, network externality is because of the SAR function for default risk. My default risk depends on others, my counterparty's default. And market power is because of Cournot. So it's not like a perfectly competitive price for the terms of trade. But what is the inefficient cost allocation? I don't really have an understanding of that yet.
Yeah, so I should be clearer that that is effectively another outcome of market power. So the market power introduces a wedge between the equilibrium and marginal costs that we get to and the marginal cost that the social planner would introduce.
Okay, so if price was determined competitively, then would we have only network externality remaining?
Yes, I think that's right. I mean, one of the points that I'm taking from this and from Yinan's discussion is to vary some of our end results, which measure the inefficiency in terms of the distance from the frontier by varying parameters. So to remove market power and to redraw the same things, and to therefore give a more precise answer as to exactly which inefficiencies are contributing to which. The reason, and Yinan said this, the reason that we say it's mostly due to networks to externalities is because we can see that the social planner reduces the exposures on average, which supports network cost externalities over market power, which would imply that they should be increasing supply. But as Yinan has pointed out, we can give a more precise answer to that.
Let me ask some more about these inefficiencies. So you mentioned when you talked about them that they have opposing effects. One of them would increase the network, the other one would shrink them, if I recall correctly. Would it be possible from the theoretic viewpoint to have a situation in which you have these inefficiencies in, because they go into opposite directions, they exactly cancel out, and we are in a good world?
That's a good question. And the answer is I don't know. My gut feeling, in a slightly uninformed way, would be no, but I don't have a very precise answer for that. But yeah,
I guess in some sense that wouldn't, you want the answer to be no, because otherwise there's no, it's weird to have inefficiencies in that then cancel out perfectly, so that there's no room for regulators to remove the inefficiencies. That would say something about the model, that it might be weird, no?
Yeah, it would be weird. And it would also, I think, only happen under very specific circumstances. So, I mean, there would still be a state-dependent role for regulation in other circumstances. But yeah, it would be, I think, somewhat undesirable. But my guess is it wouldn't.
So maybe following up on Miana's question, even where it might be useful analytically, though, to characterize network that leads to efficient outcome. It might help you with the comparative statics, would allow you to use maybe envelope argument to study change in welfare, and leads to nice formula.
Yeah, I think that's right. So one thing we can do, for example, is to switch off one or two of the non-linearities in the model, which will allow us to get closer to analytical results in a way that then will make comparative statics clear. So it's not possible at the moment because it only admits a numerical solution, but we're working towards switching some things off in a way that will make things clearer theoretically, as opposed to me drawing a graph and showing how things vary exposed.
Can I ask a little bit of about the estimation? So do you have enough power to estimate all these gamma IJs? Because these are clearly super important in your setup, right? So
yeah, sorry, yes, continue. So Yinan pointed out an omission, which is something I should have been much clearer on, which is in principle they're identifiable, but we actually parameterize that gamma IJ. So in the event, the baseline defines an n by 1 auxiliary parameter, let's just call it gamma tilde, and then gamma ij is gamma tilde I times gamma tilde j. That's common, for example, in estimating variance covariance matrices, which face the similar thing. But we're going to change that because it's a little bit restrictive in some ways. But you're right that in principle it's identifiable, but we don't have the power. I should have made that clear in the presentation.
Okay, so Brianna, do you want to ask your question, or we can move to the next paper? It's up to you.
We can move on. That's okay.
Okay. All right. So next we're gonna have Norman Shurov. He's gonna present all-to-all liquidity and corporate bonds.
Okay, hello everyone. It's really nice to see all of you from Lausanne, and I invite you to follow watching the sunset in Lausanne just behind me. So let me share the screen. All right. Maybe I should start actually by thanking the organizers for putting our paper on the program. Dimitri and Terry are on the call, so if you want to ask questions, I think they will be more than happy to handle a chat. So let me start. What is all-to-all? What do we mean by all-to-all? It's a technology that enables direct client-to-client trading in over-the-counter markets. And so the natural question to ask here what happens when institutions in OTC markets are able to trade directly with one another? And to give you the answer right away is what we find in the paper is actually they do this very little. Once you have that technology in place, there is little pickup of actual all-to-all trading. Now, from a revealed preference perspective, if you ask, do institutions prefer to trade with or without dealer intermediation? It looks like they actually have a preference for intermediation. And we find very little evidence for this intermediation coming from that technology. Now, if you broaden the question and you go to looking at what's the overall market impact of all-to-all trading, then despite the fact that there's very little pickup of direct client-to-client trading, there is still a big impact on the market. And that shows up in that prices for clients are actually improving. And at the same time, the competitiveness of trading improves as well. And that comes from two effects. One is a direct effect from the entrance of new participants in the market, and an indirect effect on the behavior of existing market participants. And that's pretty much the paper on one slide. So let me give a bit of background. I'm facing here experts on OTC markets, so I don't need to explain much what they are and why they are important, but it's clearly an important market structure. What's interesting about OTC markets is they have no formal structure. There is no centralized limit order book. At the same time, there's a lot of opacity and fragmentation. So search and other informational frictions are really important. And for that reason, historically, dealer intermediation was really crucial. Now, there have been a few recent trends that have impacted the evolution of OTC markets. On the one hand, that is regulatory changes. We've seen the introduction of TRACE, MSRB in municipal bonds and so forth. So we've seen post-trade transparency. After the financial crisis, we've seen limits on prop trading, and we've seen other regulations, and they have impacted the intermediation capacity of dealers in this market. Now, on the other hand, we've seen and we continue to see technological disruption, especially electronic trading and electronic trading platforms like RFQ, request for quote platforms, that have impacted the market. And maybe one of the latest trends is all-to-all trading. Now, the natural question here is the evolution that we move from decentralized to centralized OTC markets, is it inevitable? Will we just end up with something that on top here I've illustrated, where on the left it's the traditional OTC market that is dealer intermediated, and are we moving to a system that really looks like a centralized market like we have in stocks? Now, to give you some background on some of this evolution is actually happening, let's look at electronic trading and corporate bonds. And here I use data from Market Access. Market Access is one of the biggest electronic trading platforms, or is the premier electronic trading platforms for corporate bonds. If you look at the chart, and I'll show you many charts like this where I have time on the x-axis. If you look at this, you see that electronic trading has almost doubled, if not more, over a course of just the last 5, 6, 7 years. Now, much of this activity is concentrated in standard trade sizes, so I don't talk about the very big transaction sizes, but in standard transaction sizes, we see a lot of electronification. Just to highlight this dotted vertical line here, this is an event we're going to study in the paper. This is an entry event by a market participant on market access. So then the question, what is the impact of all-to-all trading on OTC markets? You can think about it in different ways. I can think about at least 3 channels that can happen. The first one is maybe the most obvious one, is that maybe we do see disintermediation of traditional dealers and we see pickup of direct client-to-client trading. That would be the most natural maybe prediction. But you could also think about it differently, is that maybe all-to-all is a way for existing dealers to expand their trading networks. We know that trading networks are really important in these markets, and maybe it's a tool to expand business for existing dealers in the market. Now, a third possibility is that actually this is a way for new types of dealers, we call them quasi-dealers, for these types of dealers to enter. Now, what could be the impact of those dealers on existing dealers? It could go either way. It could be that they crowd out existing dealers, or it could even be that they crowd in existing dealers. And so in equilibrium, we will see actually more intermediation than we would see without all-to-all. So what's a good, suitable empirical setting to ask these questions and answer them? I think looking at a mandated regulatory invention is probably not the right way to do this, but to look at something like a voluntary adoption of a private market solution. And this is exactly what we're doing in this paper. So the setting we have is market access has introduced all-to-all trading. They actually call this open trading in 2012. So what is market access? How does it function? It's a request for quote platform. It's basically a first price sealed bid auction. And in 2012, they allowed this all-to-all. And all-to-all means all participants can respond to an RFQ. So you see this on the at the top here in this picture. It's basically a screenshot from an actual RFQ request. And what you see here, there's a lot of information about how do you want to initiate that request for quote. There's the time. Is it 2 minutes? Is it going to run for 2 minutes, 3 minutes, 5 minutes, and so forth? The bond that this initiator wants to trade is 5 million of a GE Capital bond at a coupon of 5.55%. And then on the right, what you have is what I've highlighted in red. You have the traditional way of initiating the RFQs, where you basically select the dealers you want to send this RFQ to. These are the permission dealers on the platform. And the innovation is at the very bottom is this one-click solution where you just click on this. And if you click on open trading, then basically the request goes out to everyone on the platform, including all other buy-side institutions, everyone that is there. Now, the adoption of that click has been really big. By the end of our sample, 96% of all RFQs are actually initiated with open trading enabled. Now, once the trade is done, this is how it looks like when it's done, when your RFQ was successful. So basically in this 5 minutes, 3 minutes, everyone on the platform can respond. If a traditional dealer is the best bid, then the traditional dealer gets it. But if somebody from this open trading system is the highest bid, then that market participant gets the trade. And that would be, if you look at the sale, if you look at the ticket here, that would show up at the bottom in the counterparty information. In that case, you will actually not see who the actual counterparty is that provided the liquidity, but market access itself will stand in the middle because there's no direct credit relationship between that liquidity supplier and that liquidity demander. And for those that study trades, it will basically be 2 tickets in trades. One is between the seller, in this case, and market access, and another one between market access and the buyer. So what was the pickup of open trading over time? You see that in 2014, there was very little still at the very beginning. It was a small fraction of electronic trading on market access. But over the years, there has been steady growth with maybe 2 time periods when there was a pickup on this. One is the first one is around 2016, the dotted line, and the second wave of adoption was in 2018. So initially it was roughly 0, and by the end of our sample, it's more than 10%, or it's almost 10% of trading volume, and it's more than 15% of all trades that go on, of all RFQs that go on market access. Now, when you
Norman, can I ask a quick clarifying question? So
Sure.
let's say I'm a hedge fund and I submit an open trading, request. Do people see who I am, or it's all
no.
anonymous?
No, it's that part is anonymous. So the dealers, the permission dealers would see you, but on open trading, you're anonymous. So when you split, when you look at who actually provides liquidity on open trading, and you split this into, what we do is we split it into actual buy-side institutions, so true clients. You split it into existing dealers that expand their business, and you look at quasi-dealers, new entrants in this market. This is what you get. And when we first looked at this, at least to me, this was very surprising. If you look in 2014 at the very beginning, it was indeed the case that client-to-client direct trading was the majority, around 90%. That's the red line. But very quickly thereafter, if you look at the blue line, it was existing dealers that used open trading to expand their existing dealer networks. Now, if you look at the red line over time, you see there is a consistent decline in direct client-to-client trading. Yes.
Can I ask a clarifying question? So for the quasi-dealer, are these non-FINRA registered dealers? How do I think about them? So who are they? How do you define them?
So they're, I'll show you in a second how we define them in the data, but they're basically not permissioned on market access. So they don't basically have a contract with market access to be a permission dealer, and they will not have a credit relationship with that initiator of the RFQ. And they don't need to be a registered dealer, which is kind of getting at your question. So if you look at direct client to client, it's basically declining all the way. If you look at this expanding of existing networks, it's kind of flat throughout the sample. It varies between 20 and 40%. But what's really striking is the green line, where new entrants come in, and it starts at 0, and it basically is now 60% of all open trading. So what that means is basically all-to-all is no cure-all for the lack of direct client-to-client trading, and that's at least for 2 reasons. There has been a slow adoption by the buy side of all-to-all, and on top of that, there has been a rise in quasi-dealers. Now you could ask the question, why is there this lack of investor pickup? And I think that's a super interesting question, but that's not the focus what I'm going to talk to you in the next few minutes. Despite the fact that there's little pickup by clients directly, there's still going to be an impact on the market, because it's going to impact competition in the market, and it's going to impact the prices that clients receive. So how can you think about this impact? Well, the most natural impact is if OT wins an RFQ, there will be a direct improvement in price. So that's the direct effect of entry. But there's also an indirect impact of OT, which is it will change the competitive environment. It will change the bidding function, if you want, of the existing dealers, because there's an increase in the number of bidders, and standard auction theory tells us that will basically mean there's more competition, there's going to be less bid shading, and so forth. But there's a third effect, that entry of OT might also affect dealers' participation in the market. And that could go either way. That could be crowding out, could be, for instance, if bidding is costly and now expected gains are lower, you could get crowding out. Or it could go the other way, that actually now dealers are incentivized to improve their trading technology, and that could even crowd in existing dealers. Now, how can we get at this, and how can we measure the overall impact? just looking at execution costs, looking at trading costs, I think is too crude to answer this question because there's so many confounding factors. But if you have bit by bit auction data, I think you get a much cleaner picture of this. And this is what we do. And this is what we find. So if you quantify the effect, the direct effect of OT on prices in the market is that they improve prices by 2 basis points unconditionally. Now, if you put this in perspective, average trading costs, one-way trading costs are 10 to 20 basis points during our sample period. So the direct effect alone is like 10 to 20 basis points of trading costs. If you decompose this into what comes from the win rate and what comes from price improvement conditional on winning, the price improvement conditional winning is actually quite big. So when OT wins, they improve prices by 10 to 30 basis points. So quite significant. What is still relatively low is the win rate. It was 0 at the very beginning, and at the end of our sample, it went up to 12%. Now, the indirect effect of OT on bidding and entry, we find that dealers, the existing dealers, they improve their prices by up to 5 basis points, controlling for the number of bidders in the RFQ. So that's a significant indirect effect of OT. On top of that, we find evidence that is at least consistent with crowding in. We find very little evidence of crowding out. The way we do this is, what happens to be the case is that much of quasi-dealer entry is actually a single quasi-dealer that ends up to become a dealer at the end of the sample. But if you look at how dealers bid before and after the entry by this quasi-dealer, they bid much more aggressively after the entry of that new guy. So what that means is OT enables the broadening of existing dealer networks and the entrance of new market makers, but not really less intermediation. And if you quantify the total effect, we see a big total effect of 7 basis points or more, with the indirect effect on the market being bigger than the direct effect on the market. So let me walk you through data and how we define everything and all the measures and the model we have to quantify the indirect effect of entry. So the data we have is basically complete bidding data on market access on all successful and all failed RFQs for roughly 5 years. These are 7.4 million RFQs, out of which 5.4 million were successful. So that's a success rate of 73%. We have identifiers for the counterparty, who is the initiator of the RFQ, who is the respondent. We have identifiers for if OT is clicked, if it's enabled, how many OT responses there are, if OT wins, if OT is the cover, so if OT is the second best bid. We merged that with trace and merchant, and to give you an idea, is basically a typical transaction here is a typical bond. 46% are client buys, 54% are client sells, so it's roughly equal. The average trade size is 500,000. The bonds are like 10 years average, 3 years old, 4% coupon, 92% are investment grade, and so forth. The way we classify the liquidity suppliers on OT is basically we split them in 3. Based on how much liquidity do they demand, so how much do they initiate RFQs relative to how much do they respond to an RFQ, so how much liquidity do they supply, and overall how active they are in the market. And what we get is basically that around 750 are buy-side institutions that demand and supply liquidity on market access. 173 are traditional dealers. So traditional dealers are dealers that supply liquidity both on the traditional RFQ system and on OT. And the quasi-dealers, we have 81 of them. And these quasi-dealers, they supply liquidity almost exclusively on OT. Now, the exact threshold we use, we played with them, they don't really matter too much. And I think they get at roughly the separation and the different behavior that we see in the market. If you look at adoption of OT, the first blue line here is in 2014, just want to highlight that number. 79% of all RFQs were OT enabled. At the end of the sample, it's 96, so it has increased, but it was pretty high already in 2014. If you look at the trades that were OT, it was 1.2% in 2014, and now at the end in 2018, it's 12.4%. So there has been this increase in OT. If you look at the bottom, if you look at the share by the three types of liquidity suppliers, it's really now quasi dealers were just 14% at the beginning, and now they're 60%. So how do we measure the impact of OT on the market? We basically have three measures. One is how competitive is the auction, and that's really the difference between the best bid and the second best bid. So between the price of the security at the end and the cover, which was just the losing bid. Then there is price improvement. So if OT wins, which are illustrated here on the right, so if OT comes in at the top, then there's going to be price improvement, in this case of 20 basis points. But it could also be like this, the second case, if OT doesn't win, OT is just a cover, then really the prices don't improve directly, but the competitiveness improves. And so this can actually change the incentive to bid differently over time. Now there's an accounting relationship, is that the change in RFQ competitiveness is just the difference between the cover improvement and the price improvement. So let me show you how this looks like in the data and over time. So the blue line is the expected price improvement, the direct effect of OT on prices. And what you see is that at the very beginning, there was little OT. And so price improvement, direct price improvement was still pretty small. But starting in 2016, we're talking about 1 basis point price improvement on average. And towards the end of the sample, we're talking about 2 basis points. Now, the red line is the expected cover improvement. And you see that's bigger, actually much bigger than the expected price improvement. That's roughly 44 basis points towards the end. The difference between the two lines is capturing the change in competitiveness of the auction. If you now split the expectation into what comes from the win rate and what comes from the price improvement conditional on winning, these are the two charts I show you here. You see the win rate was initially pretty low, but it increased steadily over time to more than 10% towards the end. If you look at the price improvement conditional on winning, it's pretty large. It's like between 10 basis points and 30 basis points in the middle of the sample. But you also see a decline after 2016. What you also notice that as the win rate goes up, the price improvement goes down. And that's in a way natural, because once you have more entry, you have more bidders, the scope for price improvement declines. Now, to look at this more specifically, let's look at competitiveness of the auction. What you see is the auction competitiveness is kind of the mirror image of this price improvement chart. So here all the numbers are negative. Negative means so that a bigger number means the auction is more competitive. So here on average, maybe the competitiveness is minus 20 basis points. And so that means that the best bid and the cover, they're 20 basis points apart. Now I show you 3 lines here. What are these 3 lines? The blue line is the competitiveness of the auction with traditional dealers included and OT included. Once you take out all the OT bidders and you only look at competitiveness coming from the dealers only, that's the red line. And the difference between red and blue, that's really the direct impact of OT on competitiveness of the auction. Now, the interesting one is the green one. That comes from the model. I haven't told you much about the model yet, but let me show you the result here. The green line is a counterfactual competitiveness of the auction if OT wasn't there. And for that, we have a model, but this is what you get. You basically, if you look at the total impact of OT on competitiveness, is the difference between blue and green. And you see that's a pretty significant difference. What you also see is that the difference between blue and red compared to red and green is much bigger. So really the indirect effect of OT on the market seems really big. Now, if you look at the green line at the very beginning, at the end, you actually do see that competitiveness without OT at the end of the sample would be much lower than it was at the beginning. Whereas the realized competitiveness of the auction, the blue line, is actually better at the end. And the difference comes from OT. Now, naturally, competitiveness is a function of the number of bidders and the OT participation rate. So let me give you briefly some numbers on this. Here's a histogram of the number of participants. In every RFQ, you have between 3 and 5 participants on average. The OT participation rate is on average roughly 40%, but it's also increasing over time. Conditional on OT participation, you have roughly 1 bidder in an auction bidding. If you look at this over time, you see 2 things. If you look at the blue line, this is the pickup of OT over time. And you clearly see that the beginning was very low. And then in 2016, where the dotted line is, there was a first pickup. There was this entry by a market participant. And then in 2018, you see another big increase. If you look at the red line, that's the participation in RFQs by permission dealers. And what you see there is that it was initially declining until 2016. But after the entry of this quasi-dealer, it actually reverted. There was re-entry by permission dealers in the market. Now, I don't want to say this is causal, but it certainly does not look like there's crowding out. Now, to get at this indirect effect of OT, one thing we can do is we can look at RFQ competitiveness before entry by this quasi-dealer and after entry by this quasi-dealer. And if you just plot competitiveness conditional on the number of participants before and after, you clearly see that the competitiveness of the auction increased after the entry of this quasi-dealer. And if you translate this into price improvement, you get roughly 1 basis point. So there's an indirect effect of entry by this quasi-dealer, and it improves prices by roughly 1 basis point. Now, to do this more formally, and to get at these counterfactuals, we have a very stylized model. It's a standard seal-based first price auction with n-1 RFQ responders and 1 OT bidder. The probability of OT entry and the number of bidders is known. These bids are drawn from a continuous distribution, and that distribution may depend on the number of traditional bidders and on the probability of OT entry. What you get out of this is basically you can decompose the total price improvement coming from OT into 2 components, actually into 3 components: the probability of OT entry, which is the P, the direct price improvement, this PI, which we can measure in the data, and then the indirect price improvement coming from the changing bidding distributions, the changing strategies of the existing bidders in the market. You can do the same for the cover improvement. Now, what we can also do is we can decompose competitiveness in a similar way. So there are 3 measures of competitiveness. One is the observed one. The other one is the observed one taking out OT, so only looking at the traditional bidders. And the interesting one is the competitiveness if OT was absent. And what the model does, it basically helps us to back out from the observables, what is this counterfactual competitiveness? And that's the equation you have here in the middle. What you see is it's a function of the observed competitiveness, the probability of entry, the price improvement we see, and the probability of OT winning conditional on participation. We have all this data, so we can compute all this. And this is the graph you get that you've seen before. So that's the green line we can back out from the data. And again, what you see is the direct effect is much bigger than the indirect effect. Now, another complication that we have in the data is that there is not always just one entrant, but there may be J+1 entrants, OT entrants in the market. In the model, N is naturally integer. In the data, we have an expected N that is a real number. So what we do here is a locally linear approximation. What that implies, we actually need to compute a marginal price improvement curve. And that we do that, and that's how it looks like. So if you plot N, the number of bidders, against the marginal price improvement, what you get is naturally that when there are few bidders, when N is small, the marginal price improvement is pretty high still. An entrant can improve prices a lot. And here, the estimates we get is 4 basis points, 5 basis points, roughly. But naturally, as there are more bidders in the auction already, the marginal price improvement declines. What we can do with this, we can actually do some counterfactuals. What happens depending on what assumptions you're willing to take about crowding in or crowding out. What we can do is, if you assume that entry by permission dealers and by OT is independent of each other, you can fix the number of permission dealers post quasi-dealer entry. So we're talking about 2016. That will give you a lower bound on the price impact of OT. And that's the green line you have in the chart on top. And here you get something that looks like 2 basis points towards the end. Now, if you want to consider the possibility that that the quasi-dealer is some kind of first mover, and that leads to crowding in or crowding out of existing dealers, then you will fix the number of bidders in 2016, and that gives you an upper bound of the impact of OT. And that's the blue line. And here you get much bigger numbers. You get numbers that are like 6 basis points towards the end. Another counterfactual you can do, you can ask, what's the impact of OT on the one hand versus permission dealers re-entering in the market, and how much do they affect prices? And these are the 2 lines here. So the blue one is assuming that OT, everything is driven by OT, and we fix the number of permission dealers, and blue is the opposite, and red is the opposite. What you see here is the 2 lines are not quite the same, but they're roughly the same magnitude. So that roughly means that the entry by the permission dealers and entry by open trading had roughly a comparable impact on the market. Now, let me just look for the last few minutes. Let me look at different OT types. I mentioned you this dotted line from the very beginning. If we split the OT liquidity providers into the non-permission dealers, institutions, the quasi-dealers, but we select from the quasi-dealers just one guy, basically the biggest guy, and that's the blue line. What you see is that that institution entered at the end of 2015 and very quickly became the largest liquidity provider in that market, all the way up to 2018 when there was a second wave of entry. And then non-permission dealers are now the biggest respondents in OT. So where does the price improvement from OT actually come from? This is the left chart. If you look at the expected price improvement from OT, it is this one quasi-dealer that had the biggest price improvement, if you want, the biggest impact on the market. And especially towards the end in 2018, despite the fact of entry by non-permission dealers, it still has the biggest price improvement. Why is that the case? It's not the case because they bid more, but if you look at the chart on the right, their win rate in 2018 significantly went up. So this quasi-dealer somehow learned how to bid in a way so that starting in 2018, they could win a lot of auctions, even though they didn't participate more.
Norman, I forgot what's the difference between non-permission dealer versus quasi-dealer?
So non-permission, they're traditional dealers and they trade on OT. Yeah. And the quasi-dealers, they don't trade they don't trade the traditional OT. So maybe the last chart, the last numbers I show you, if we look at RFQ competitiveness and we look at price improvement by the different types of liquidity providers, and we look at the quasi-dealer, the last row in each panel here, it actually turns out that this quasi-dealer, the RFQ competitiveness at the very early on in the sample was actually pretty low. So originally, the quasi-dealer entered in relatively uncompetitive RFQs. If you look at the price improvement at the bottom, the price improvement that this RFQ, that this quasi-dealer provided was pretty high, higher than the other providers. But if you go towards the end of the sample, this quasi-dealer now actually enters RFQs that are the most competitive, but provides the least price improvement. So one interpretation, if you want to, you can give to this is that maybe this quasi-dealer learned how to bid. They initially participated in uncompetitive auctions, learned how to bid over time, and now they really know how to do their business. Now we have lots more results on the cross section. They're pretty much in line with everything I told you so far. So I think I need to wrap up. So we do find that OT enables the expansion of existing dealer networks, but really it's the entry of new market makers, and it's not less dealer intermediation. So if you want to have a quick answer on the question of do investors prefer intermediation, the answer is yes, at least on this platform. If you look at price impact of OT on the market, we find that the indirect effect of OT is bigger than the direct effect. So the direct effect was like 2 basis points, and the indirect effect is 1 basis point coming from more competition and 4 basis points coming from crowding in. I think this raises a lot of questions. There are many, I think there are many more things one can do and think about given these results. And thank you very much.
Okay, thanks a lot, Norman. So our discussant is Pierre Levy-Weil.
Thank you. Let me share my screen. All right. So first of all, let me thank the organizer for giving me the opportunity to read and discuss the paper. It's a very important topic in my view, and a great paper as well. I enjoyed reading it very much. In this discussion, I'm going to give you my own summary of the evidence and provide some comments. So market access is an electronic platform that sought to disrupt the corporate bond market by allowing customers to make requests for quotes. That means that originally what market access did, so before 2012, is to allow customers to invite permission dealers, so those dealers with whom they have create relationship, to small auction, and that would provide customers with an alternative to bilateral trade in the traditional OTC market. Some papers have already used market access data. Terry has an important paper in 2015, and there's a recent paper by O'Hara and Zhou in 2020. What this paper does specifically is to focus on a new features that market access introduced in 2012, which is the open trading feature, the option that customers have to broadcast their RFQ to anyone else in the market. And the question are, how big is open trading, who ends up using it, and how the terms of trade change as a result. So on the first two questions, the one important observation is that customer click on open trading almost all the time. It's almost always used. However, open trading, and that's a frequency diagram that Norman showed, triggers less response than traditional RFQ. So for instance, if I read the graph right, in 2018, toward the end of the sample, on an RFQ, there's about 6.5 response on average, and about 23% of them are open trading. Also, it seems that open trading wins less, even after adjusting for lower response rate. So again, if I read the graph correctly, on average, some OT wins 12% of the time. Something that's very interesting that Norman emphasized a number of times is that the participation in open trading has changed a ton over time. So at the beginning of the sample, in dollar volume, a lot of the open trading looks actually like customer-to-customer trade. So those institutions that are classified as buy side end up trading the most within open trading when there is an open trading win. But by 2018, the pattern, although there's still quite a bit of customer-to-customer trade by volume, in proportion, most of open trading is accounted for by the quasi-dealers, by institutions that tend to supply liquidity all the time. There's also, there's some descriptive analysis that Norman did not show that try to relate, whether OT trade to bonds or trade characteristics. And they found that there is the OT trade is somewhat selected on those characteristics. However, my reading is that the R square of that regression remains quite small. So maybe that's a feature of the linear probability regression. But that suggests in any case that a lot of there's observable characteristics don't explain a ton. What type of trade, buy, sell, what bond is being used on is trading via open trading versus not. Another paper is about measuring the impact of open trading on terms of trade. The main result is the one that Norman showed you, that unconditionally, OT improves price by the end of the sample by about 2 basis points. Conditionally, so conditional on OT win is much larger. And to illustrate and various aspects of that result, the paper offers 2 approaches. One that's quite descriptive based on price improvement and bid to cover ratio measures, and one that's very structural based on insight from auction theory. And maybe I'm very predictable, but I found that the structural approach is much more convincing. So what I'd like to do in the next 2 slides is just to explain why, and that's something that the author know, of course, because that's why they do the structural approach, why I find the descriptive approach difficult to interpret. And that goes back to something Norman says, which is that the descriptive approach makes it hard to measure the impact of OT on bidding strategies. So there's the OT is a threat to traditional dealers, to permission dealers, and that we should expect change the way they bid. So here's a very stark example to explain, why this is the case. So suppose that, for the sake of the argument, that auction participants compete à la Bertrand to say buy an asset, and suppose that with OT and traditional dealers there are 3 bidders with valuation V1 greater than V2 greater than V3. Suppose that non-OT bidders are V1 and V3, and OT is always the second highest bidder. Then you can see that OT matters a ton, right? Because if in a with Bertrand competition, the price that is set is equal to the value of the second bidder. So OT matters a lot because it changed the bidding behavior of the highest bidder. It reduced the markdown. Yet the measured price improvement here is always 0 because the price, there's no difference between the best bid with and without OT. They are the same. The competitive measures suffer from similar difficulties because the competitive difference between the best and second bid. In the Bertrand case, they are the same. So there's 0 competitiveness, although OT matters a ton. There's another example that I've heard Randy give a number of times in this seminar, I think, which is coming from Burdett Judd auction when there's uncertainty about the number of bidders. And in this case, price dispersion is non-monotonic in competitiveness. When the auction is super competitive, then all price bunch around the competitive price. When the auction is not very competitive, all price bunch around the monopoly price. So non-monotonicity means that if there could be a clear increase in economic competitiveness, but decrease or increase in measured competitiveness. So the author, of course, understand this very well, and that's why they do the structural analysis. What I'm hoping is to convince them to put more of the structural analysis earlier in the paper. And the reason is that it offers a cleaner measurement of the impact of OT on price. So here, maybe I could suggest a couple of additions that could be to the analysis. Something that looks interesting is to consider heterogeneity amongst OT bidders. It looks like, although customers are a smaller fraction by the end of the sample, they still bid quite a bit in volume. And presumably, they have different valuation than quasi-dealers. Something that Bachimeng brought up early in the talk is that there's difference in information as well. And maybe that's why there's difference in win rate between OT and non-OT bidders. The OT bidder seems to have less information than the traditional dealers. There are also difference in fees. And also for the study of the crowding in and crowding out, I thought that it might be important to study, in the time series, the impact of other factors in attracting bidders to the market. So this is a time where market access improved a lot its share of trading volume in corporate bond. And I was wondering, a bit naively, whether or not crowding in could be accounted for by, liquidity externality, maybe on the market access platform. My naive idea was that the competition from OT would create more crowding out rather than crowding in. So I was wondering how other factor could matter. So in my last slide, I would like to take issue with something that Norman did not say, but was the conclusion. The author writes that search and network friction are small in the market because you can reach everyone through open trading. So why does intermediation remain central? So I'd like to offer maybe a different interpretation of what goes on in the market that suggests that maybe search and network friction are not so small. Okay, so here's the way I'd like to think about what goes on. So, okay, it's true that OT allows to contact everyone in the market. That's true. There's nothing to argue against that. However, it's also reasonable to imagine that everyone is not present in the market at the same time. Bidders may be busy doing something else, trading other bonds, speaking to their clients, etc. And seems reasonable because the number of responses remain low in RFQ. So what that suggests is that there's some random component in the number of responses that come from factors that have nothing to do with what goes on in the market, and that it's not literally search, but it's observationally very similar to search. I bet you I can write a model where it's observationally equivalent to search, and we can argue whether or not it's the right model. So through that lens, one way to interpret open trading is as a technology that make the market fully decentralized. What fully decentralized is a reference that inside baseball. It's a reference to stuff that the market, bilateral search market in which all counterparty can be reached as opposed to just specific dealers. And there's quite a substantial literature on those fully decentralized markets over the last 10 years. There's several, many prominent contributors in this Zoom room. So this model study what happened when instead of just trading through dealers, you can also maybe reach customers. Something that's interesting about this class of model is that the emergence of the quasi-dealer maybe is no puzzle in that case. The fact that there's random response means that intermediation arises endogenously. Just basically, it does not eliminate the demand for immediacy, and agents who end up being maybe randomly or more often randomly present in the market end up playing the role of intermediaries, even though they are not the final holder of the asset. So maybe that sort of model can help shed light on the quantity choice of quasi-dealers and customers. That would be semi-econometrica paper. And so Bashir makes point that the non-OT dealers have more information than the OT dealers, means that maybe the recent paper of Zach and Bruno could help also think about the different bidding behavior of those two categories, because they consider models where there are some experts that have more information about their customers and non-expert who have less information about their customers. All right, so I'm going to stop here. It's a great paper. There's lots of very interesting evidence, and I want to argue that it remains amenable to such a matching analysis.
Okay, thanks a lot, Pierre. From audience, if you have any questions, please use the raise hand feature. Otherwise, panelists, feel free to jump in and ask questions.
I had a quick question. Maybe you said this and I just missed it, but Pierre mentioned that certain types of trades were more likely to generate OT responses or be won by OT participants. So did you guys look at price improvements where like a non-OT, like a traditional dealer might expect more competition than not? You know what I mean?
Yeah, so this is the stuff at the end I didn't get to. We sort of do lots of cross-sectional stuff too. What we find is that most OT entry is actually not in the least liquid, in the least competitive auctions, but it is in the more competitive ones.
So the ones that were sort of pre-OT more competitive.
Yeah.
I see. Okay, because I guess I was just
so it's not in that sense, it's not liquidity provision at the bottom, but it's liquidity provision at the top.
I see. Okay, thanks.
So maybe would you be able to clarify kind of the questions I had on the information structure? Like I guess on when they're submitting, RFQ to permission dealers, then the permission dealers see which other dealers are bidding, for example?
No, it's sealed bid.
Okay.
So if say a buy-side institutions initiates the RFQ, they select the dealers. The dealers will see the identity of who is initiating the RFQ. They will not see the other bids. That same thing is true for OT. OT, different to traditional OT, will be two-sided anonymous. Can I briefly respond to Pierre-Olivier? I have a confirmation bias, so anything he said structural, yes, Burton is smiling, I can see. I hope my co-authors are listening. We've had that discussion about the model, so I'm more than pleased with Pierre-Olivier's suggestions. I think the stuff about the endogenous intermediation, I think is also fully in line with how I want to think about it. I think the evidence in the paper actually does support this strand of literature that you're highlighting, and maybe that's exactly the way we should go, and that's the way we should think about this market.
Can I ask a question about one of the counterfactuals you mentioned also in the graphs? Did I understand correctly that you're assuming that the number of bidders is the same pre-OT and post-OT? And isn't that problematic because you're talking about the entrance of new bidders post-OT?
Yeah, so good question. What we're trying to get at in these counterfactuals is to quantify, to separate, because we have entry by OT and we have re-entry by permission dealers. In the counterfactuals, we're trying to separate the two. And so what we do is we fix, so the number of bidders is time varying, but in one exercise, we fix the number of permission dealers in 2016 and we keep it steady. And then we let OT enter. And then basically you're moving down that marginal price improvement curve. And in the other counterfactual, we do the opposite. We fix OT and then we let the permission dealers enter. And that gives us sort of an impact of what each party has.
I'll ask more questions if there are no other questions. So I think from Pierre's discussion, I got that there is no difference in terms of which bonds are being, used through OT versus not OT. But what about like who's using OT on the client side? The initiators of OT, is there any difference between those who are using OT versus sending their RFQ to permissioned dealers?
Yeah, this is a great question. We only have identifiers for the initiators. So the best in a way we can do is we can look at, say, their past activity on the platform, the sizes they trade and so forth. I feel like this is opening up a whole new set of interesting questions, and we haven't really dug much into those, but I think it would be pretty interesting. Yeah. But what seems to be the case is that the ones that switch from demanding liquidity by initiating to supplying liquidity, this is the ones we basically identify, we look at, and these are the ones we call these buy-side institutions.
I can ask another question if you want to ask. Oh, go ahead. Go ahead.
All right. So sorry, I was just following up on your last answer. Do you see the quasi-dealer going back and forth between buying and selling, or is providing liquidity mostly on one side?
So, I mean, there is a bit of this issue with how we define it. There might be a circular argument at some point. We define a quasi-dealer as a market participant that is active in the market, but it is more active on OT than on the traditional system. And the ones that are really most active on the traditional ones, we call them the traditional dealers. But then by definition, OT is mostly active in OT. And by definition of the criteria, they can demand and supply liquidity, but they will tend to mostly supply liquidity. The ones that demand and supply, they're by definitions the buy-side institutions.
Sorry, Pierre, was your question about whether or not the quasi-dealer is managing its inventory? And we see
that's right. That's right. It was not about supply of liquidity, but on being on the buy side or the sell side. So that was gross exposure on that exposure. Yes.
Right. So you're really looking like, are they actually acting like a market maker? Whereas when someone sells to them, they later sell to someone else. Yeah, I don't think we've looked into that, but we certainly could. The only issue is if they're doing any trading off the platform, that will make it harder.
But you can, I know, because they're not FINRA dealers, so you can't follow them.
Well, eventually we could, but not for most of the sample.
So this discussion goes in the direction of the question that I wanted to ask. So on the conclusion slide, the punchline, do investors prefer intermediation or not, seems to depend crucially on how you define investors versus the quasi-dealers. And that was, it, I guess, is similar to the point that was just asked. Who should we call the quasi-dealers, or are they just active investors? And does that matter for how we see all-to-all trading?
So for the single large quasi-dealer, there, if you search the Wall Street Journal, you can perhaps discover who that is. And that is a firm that might be thought of as a high-frequency trader or an ETF market maker. For the other ones, it's a little bit trickier because, right, you could imagine that there are some active market participants who decide that they're willing to tilt their portfolio some to earn the liquidity premium. But they're certainly not the majority of these quasi-dealers.
All right, so we'll leave the room open. I think we're coming back at 12:30, right? For the next two papers. So thanks a lot to the discussants and presenters so far.
And now we don't hear anything because you're muted.
Sorry, I've never learned. Okay, so unfortunately, I don't have a voice this morning. I was really excited to present to this OTC paper, so I decided to go through. Unfortunately, you're gonna have to kind of pump up the volume of your laptops, and if you cannot understand anything, please signal, and I'll try to improve or change how I speak. So thank you to the organizer for including this paper, and thanks to Barton to agree to discuss it. I'm very excited to hear what he's gonna say. So at the core of the paper, there is this very simple observation, which is that, in a number of the markets, financial or not, okay, this is not working. Financial or
Sorry, we can't hear you, Julia.
Can you hear me? Okay. When a consumer has to pick a product, they're going to have to choose among a huge number of extremely customized alternatives. And, we all agree about the benefits of product variety. But if you ever happened to shop for insurance, sign up for a credit card, get a mortgage, you'll have to agree with me that choosing among these extremely customized alternatives is difficult. It's difficult to compare the alternatives, and it's difficult to find the alternative which is best suited for your needs. And this very simple observation highlights a very natural trade-off when we think about product variety and product attributes. Now, how this trade-off is solved really depends on the incentives of the producers when they sit down and decide the attributes of the products that will actually be offered in the market. In this paper, we focus exactly on this decision, and we want to understand how producer decision about product attributes shape the search frictions in a market. And we want to explore the incentives of the producers to offer extremely customized products exactly because they want to hinder or complicate the search process for consumers. And we are going to explore these issues in the context of the US municipal bond market. So, you know much more about municipal bonds than my average audience. But for those of you who are not familiar with this market, these are securities issued to finance investment in infrastructure. 95% of the investment in public infrastructure in the US is financed by issuing municipal bonds, which makes this market all the more important given the dire state of investment of infrastructure in the US. So I'm going to talk a lot about bond attributes, and at its simplest, these include a maturity, a face value, and an interest rate, which is paid every 6 months. However, municipal bonds are almost never this simple. And in fact, at origination, a municipal bond is usually enriched with a number of special provisions, such optional redemption, partial collateral. And while understanding how each one of these special provisions works, it's not really necessary for the purpose of the paper. I want to walk you through one of these features to make sure we are all on the same page. And these features is optional redemption. So basically, I'm sure you all know this, but this is a contingency that allows the issuer to call back the debt either in full or in part under some special circumstances at a price which is either agreed upon in advance or anchored to different indexes. And if you think about it, this contingency introduces some flexibility, which is valuable for the issuer, because if they have a sudden influx of cash, they can use it to pay their debt. It's also it also introduces a risk for investor, because if the issuer actually calls back the debt, you lose all the future interest payments. And this is a risk which is kind of difficult to evaluate and to price, because you have to think, what's the likelihood that this will happen? What's the price I get if that happens? What is the market price for the bond when that happens, and so on. And very much like this attribute, the special attributes we are going to focus on, you can think of them as introducing some flexibility that moves some risk from the issuer to the investors or vice versa. And that this risk is kind of difficult, non-standard to price and understand. So the special attributes for the majority of bonds that are municipal bonds issued in the US, these attributes are set at origination through negotiation between the issuing government and an underwriter, the financial institution in charge of the initial marketing of the bond. After origination, the bond is traded in a standard decentralized markets. And one thing which is going to be very important for our paper is that the underwriter, the same person who set the attributes and sells the bonds at the beginning of its life, it's usually very active in the trading market for the bond that they underwrote, and they maintain a market share of around 20%. This market is well known to be characterized by very large search frictions. And in fact, the SEC repeatedly has drawn a connection between this large search friction and the existence of these extremely customized bonds, advocating in favor of reducing what they call bespoke bonds, which are these customized bonds, in favor of increasing liquidity. So what we are going to ask is, does the incentive structure at origination distort the bond attributes and the level of customization in this market? And if so, should the government intervene, mandating standardization? And I want to emphasize that this question, even though very relevant for the market for municipal bonds, resonates beyond it. Because in a number of financial markets, think of insurance, annuities, corporate bonds for that matters, we have seen the proliferation of these extremely complex, customized financial products, which in turn has sparked the debate over the benefits of mandating standardization. And to contribute to this debate, we are going to start with an instrumental variable framework, which we are going to use to get a sense of the trade-off that underwriter and issuer face at origination when they need to decide these bond attributes. And then we are going to design and estimate a model of the bond design and trading, which we are going to use essentially to think about standardization. To give you an idea of the result, we are going to find that, again, using our instrument, that if you add a large number of the special provision to a bond, the trading market for that bond is going to be more illiquid, pretty much in line with what you would expect. And this goes to the great detriment both of the underwriter and the issuing government. On the plus side, if you ask anyone in this market, they'll tell you that the issuing government values the special attributes. And the reason is that it gives them some flexibility that allows them to time the payments of the bonds so that they are due in moments where the issuer has most liquidity. We find evidence of that. On the side of the underwriter, they also value the special attributes. Why? Well, what we find is that by packing a bond with a large number of the special attributes, the underwriter is able to lower the competition that they face from other financial institutions in the trading market for the bond. Now, the fact that the underwriter even considered positively this decline in competition in the trading market of the bond points to a distortion or a possible distortion in how these bond attributes are determined. And this, because of that, it's not surprising that what we find with our structural model is that by mandating standardization, policy mandating standardization deeply hurt the underwriter whose wealth falls by 13%, And the reason is that, again, all of a sudden they have to face tougher competition from other dealers when it comes to intermediating the bond. Investors benefit from the policy because they benefit from the higher liquidity, lower search frictions in this market. The government, interestingly, is hurt on average. And the reason, again, it's because they suffer from not being able to design these bonds in a very flexible way. It's important to emphasize that this average result hides a lot of heterogeneity. And in fact, the negative result for the government is really driven by smaller government issuers with very volatile revenues who really benefit from the flexibility of the special attributes. So if there are no questions, and if you can all hear me, yeah, okay. Let me give you a primer on the market of municipal bonds. So the life of a municipal bond starts at origination. We are going to focus on negotiated deals. This is around half of all the municipal bond issuances in the US, 65% in value, whereby a government basically has a financial need and they are going to handpick an underwriter, and then they start negotiating over the bond price and its attributes. At the end of the negotiation, the underwriter buys the bond from the government and starts and can resell it to other dealers and investors. After that, the standard trading secondary market of the bond starts, where dealers and investors trade the bond until maturity. Now, before I tell you anything about our data sources, I want to give you a sense for this market. So let me show you some summary statistics. First of all, these bonds are small. The median bond has a municipal bond, has a face value of $6 million, a maturity of 8.5 years. As I mentioned, the trading market for these bonds is very liquid. Just look at the intermediation spread, which is on average 1.3%. This is basically 10 times as large as the same number for corporate bonds. As I mentioned, the underwriter usually also very active as a dealer in the market for the bond that they underwrote, and for this, and they intermediate 20% of the trades for these bonds. Importantly, it's not just that the underwriter are bigger dealers. In fact, if you look at the same institution, they intermediate only 3% of the bonds that they did not issue, underwrite. Who are these issuers? Mostly small governments. Think of cities, counties, school districts, special purpose governments such as water districts, sewage districts, and so on. So we're going to talk a lot about the negotiation between issuer and underwriter that determine bond attributes. And I want to emphasize that an important component of this relationship is the potential for conflict of interest. To see why, let me give you a very specific example, which is the career of this Kimberly Finney. So she started her work in the public sector, working as a CFO for Cook County Treasurer, where she was directly involved in the issuance of municipal bonds. Then she moved on, became controller for the Forest Preserve District of Cook County until in 2003, I guess she had enough of working for free, and she decided to move on and work for Bank of America Merrill Lynch, where she became government client manager. And just staring at her career, you can understand how this type of career path created the potential for a source of influence for actors like Bank of America on the local officials that are actually negotiating these bonds. So,
actually, I have a very small question on the previous slide on the nature of the MSRB data. How do you identify the underwriter? Is it anonymized or like in trades or no?
Yes, no, so the trades, so we have an identifier for the dealer intermediating a trade. So we can look at we can just, basically dealers have the option of not reporting on MSRB when they trade at the offering price. But if they want to place at a price which is higher, they have to report the trades on MSRB. So it happens that 75% of the primary market trades happen on MSRB. So we can, very easily identify just the dealer who has the biggest net sale and
selling everything. Okay. Yeah. Good.
Yeah. Okay, so this career path is problematic, and because of that, a number of states introduced, some sort of revolving door regulation that try to limit the conflict of interest coming from future employment opportunities, by limiting post-government employment of public officials. And in fact, over our sample period, all but 15 states had in place some sort of revolving door regulation, which created a lot of pressure for the remaining states to enact, from watchdog and interest group to enact, sweeping ethics reforms. Over our sample period, 5 of these states caved in, and they enacted a revolving door regulation targeting either state official or directly local officials, who are the one who actually negotiate municipal bonds. And this is useful for us because we are going to use it to build an instrument with the idea that this revolving door regulation affect the incentive of government officials when they are negotiating municipal bond underwritings, and through that it affects bond attributes. So finally, the data: every time a bond is traded, we observe the trading price quantity identifier for the dealer. And then we build bond attributes, both in terms of the special attributes that are included in the bond and information about the financial condition of a government, census, demographics, and stuff like that. And then we build a very detailed list of these revolving door regulation through the NCSL Ethics and Lobbying State Law and Legislation database. And the first thing that we want to do is to use this data to get a sense of the trade-off that you face at origination when you're deciding whether to include or not the special attributes. Now, the problem with doing that is that they are, of course, endogenous. So they may be included in response to some quirky financial need of an issuing government, which we do not observe. And to overcome this problem, we use panel variation in revolving door regulation, with the idea, again, that they affect bond attributes of newly issued bond by affecting the incentive of government officials. Now, how do we measure constellation? We are going to just rely on the literature to identify features of these bond attributes of these bonds that are uncommon and difficult to price, and we are just going to count how many of them are included. So, first thing, we need a first stage. Do these revolving door regulation affect the attributes of this bond issued? So here what you see is that looking at the first 2 columns, as the revolving door regulation are enacted, they reduced conflict of interest. The bonds that are issued are much more standardized. The number of the special attributes decreased by 7 to 9%. If you look at the regulation targeting directly local governments officials. If you look at column 3 and 4, you see that if you look at state level regulation that target state officials, the effect is smaller, 2%, which it's kind of nice because these officials are not directly involved in the issuance of municipal bonds, but they have way that they can exert influence. As an example, they decide the budget, or they have a voice in deciding the budget of these smaller governments. Now, you may be worried that what we are capturing is a spurious effect. And to make sure that's not the case, in the paper we do a bunch of control. There's only one that I want to tell you about right now, which is the following. So we look at these governments that are treated, right, for which the regulation changes. And we look at the rating of their existing bonds. And we see that the rating of existing bonds are not affected by the regulation, which suggests that there is no underlying change in the credit worthiness of these issuers that is actually driving the effect that I've shown you here. So next, we want to use this instrument to get a sense of what's the impact of having these very customized bonds. The first thing that we see is, as you would expect, adding a large number of special attributes decreases market liquidity, increasing the intermediation spread substantially. Again, on the plus side, the idea is that municipalities or local government can use these special attributes to avoid default, move around the pavement in a way that helps them. We do not observe default because it's a very rare occurrence, but we use the next best thing, which is the number of downgrade. So how many bonds and how many times per bond, it's downgraded within the first 5 years after issuance, and you see that there is a substantial decline in the number of downgrades. This also tells, let me skip this in the interest of time, but also the offering price that the government gets decreases, suggesting that even for issuing government, there is a mixed result. But what I think is most interesting is that the underwriter also benefits from packing the bond with the special attributes. And in particular, we find that the market share of the underwriter in the trading in the secondary market for the bond increases substantially if they increase the number of the special attributes. So the bottom line to take for this is twofold. First of all, when you think about bond attributes and standardization, these solve a very complex trade-off where you are trying to balance the need for flexibility and the market liquidity. And and basically the fact that the underwriter and the fact that the dual role of the underwriter as underwriter and dealer for the bond points to the fact that this trade-off may not be solved efficiently in the context of the negotiation. Yes, Pierre.
Sorry, I wanted to ask you how to interpret the size of the economic effects. Like for instance, if you move from a top percentage of attribute to a lower percentage of attribute, how much does it decrease the spread?
So the spread, so the relevant range is going from 1 to 2 of the special attributes, and the intermediation spread increases by half a standard deviation. Same thing with the number of downgrades, it's half a standard deviation. The underwriter market share, it increases by 0.1 percentage points. And the offering price, it's an average, now I don't remember, it's a log, okay. The offering price is 1%.
Very basic question. What's I here? Are these states?
No, these are bonds, individual bonds.
Okay.
And then the treatment is at the state level. We control for county acts. Yeah, we can. Yeah, so that's it.
Can I ask, what is the rating of those bonds? Is it like the bonds with more attributes do they have higher rating or lower rating?
So we control for rating here, and I don't remember actually if the rating is higher or lower. I should check. Important, before I forget. So here, not only we control for complexity, so for the attributes, but we control an instrument for the coupon rate as well. So, no worries about that. Okay, so because of this complex trade-off and this distortion, we need a model to think about to quantify and to this trade-off and this distortion. So we are going to design that. It's going to be a partial equilibrium model of bond design and trading. Partial because we are going to think about one bond at a time. We couldn't reach the model with a richer demand system. We just don't know. So, we are deciding whether we should do that or not. The model will have 2 stages. First, the bond is originated. So there is a government official and an underwriter who bargain over bond attributes S and the coupon rate R. The underwriter, in the context of this negotiation value, both anticipates the value of selling the bond at the beginning in the primary market, and then the value of the future trades that it will intermediate. And then instead of the government faces the cost associated with the bond, so they have to return the money, the face value A, they have to pay interest rates here. And we are going to allow the marginal cost of these payments to be different from one and depend on complexity, with the idea again that the special attributes can allow the government to move around the payment so that they are due when they have more liquidity and the marginal cost of the dollar is lower. After origination, trading starts. Here the model is based heavily on the amazing paper by SaMMF and in 2019 and earlier in Afonso and Lagos. So time will be continuous. Trade happens until maturity. There is a continuum of dealers, including the underwriter and the investors, and trade happens through random meeting between dealers and investors. So just let me highlight two features of the model. Each agent has a quadratic utility from holding the bond. We are going to allow this utility to be different between dealers and investors and to be heterogeneous across investors. In particular, we allow the state type mu to be heterogeneous among investors. Importantly, we are going to allow this term to depend on the number of special attributes. So a major departure from the paper I mentioned is that we allow dealers at every instant to choose the rate, the meeting rate at which they want to meet investors. And they do so subject to a search cost. Let me walk you through this search cost. First of all, there is a base level of search cost fee note that the dealer pays. We allow this to depend on bond attributes, observed and unobserved one, dealer's attributes. However, we also, introduced this second term, which basically we want to use to capture some sort of Rolodex model of search. The idea here is that if you ask dealers in this market, they tell you the easiest way to sell a bond is to contact one of your clients who already has bought or sold the bond from you in the past. If you believe this story, then the more a dealer trade, the more they expand their network, their client network, the better they have the lower search cost they face. We capture that by allowing the search cost the dealer face to depend on their client network B, which we measure with the number of total trades that the dealer has done in the past. And this parameter phi1 basically capture or measure this network effect, which we are going to estimate and allow to depend on complexity. So just to get a sense of the model, we allow bond attributes to affect investor valuation with the idea that these attributes may make a bond tailored to certain investors, to affect the level of search costs because it's harder to explain the bond to investors. It affects competition in the intermediation market because it affects the size of this network effect, and then it affects the marginal cost of capital for the issuer. So also, I don't have a lot of time to get into the model, but we allow different sources of distortion to distort the level of bond attributes. First of all, there are bargaining frictions, which means that when they underwrite, I told you that bond attributes affect search frictions for all the dealers in the market, all the investors, utility in the market. Because of bargaining friction, when the underwriter is bargaining over the bond attributes, they may fail to internalize the impact that their decision has on everyone else's utility. Second, you have this vertically integrated underwriter that may have incentive to distort the bond attributes in order to strengthen the network effects. And finally, we are going to allow for the potential for conflict of interest to mirror what we have seen in the motivating evidence and the impact of revolving the regulations. So I have 5 minutes, so I'm just going to breeze through the estimation.
Can I ask something very quick, hopefully? Just comparing model and data. So the model has these underwriters that are active intermediaries in the secondary market. Can you, in the data, can you tell us kind of the share of, an underwriter buys the initial issuance and then resells it, and then they're kind of, out, versus that they're kind of actively in the secondary market, which seems that's kind of key in the model, right?
I mean, they are always active in the market. It's a matter of what share do they have. And the average market share for the bond that they underwrite is 20%. And when I talk about market share, I'm excluding basically the first couple of months to make sure it's not capturing. I should have said that. Whenever I talk about underwriter market share, I just focus on the secondary.
Truly secondary market.
Yeah, correct. Okay, so how do we estimate this? So we want to recover the dealers and investor preferences, the search cost, government official preferences, and we observe for every bond trading quantities and prices, and the times. Then we observe, the dealer's inventory, or we can construct it, and the trading experience, and then the bond attributes that were actually chosen. The estimation, is in 3 steps. First of all, we take each bond in isolation, and we recover, the trading parameter that is dealers and investor preferences and the search cost by matching trading prices, quantities, and the timing of the trade. Second, now we have this attribute, this parameter for each bond, but we want to get a sense of how investors' valuation depend on bond attributes as an example. So the next step is using an instrumental variable regression, basically, where the outcome of interest is the parameter estimated in the first step. And finally, at this point, so after the first two steps, we can basically estimate or compute the value of the underwriter and how it depends on bond attributes and the coupon rate. So the third step, we match the bond attributes that were actually chosen, holding, controlling for the underwriter's incentives in a way that allows us to recover the issuing government's value for these bond attributes and their utility in general. So with all of that, in the last 5 minutes, let me tell you what we find. Let me start with some magnitudes about the search cost, which I think, that we may be the most interesting for this crowd. So the average deal, so let me start by telling the marginal cost that the dealer face when, for lambda equal to 0. And the average dealer pays them per month around $800 to find investors. The underwriter for lambda equal to 0 around 400. So why is there such a difference? Well, because of the network effect. So what our estimates suggest that there are substantial network effect in this market. And the underwriter is the one who actually benefit from it. Why? Because they have the exclusive right of selling the bond at the very beginning of the lifetime of the bond before anyone else can trade it, which means that they can quickly build a client network and much faster than anyone else in the market. This gives them an initial cost advantage compared to other dealers, which then continues. So if you look at the average search cost, its difference is around $1,400 for the average dealer, $4,000 for the underwriter. Why? Well, because the underwriter meets much more people. So the average meeting rate for the dealer is 5%, and for the underwriter is 3 times as much, 13%. So something about the heterogeneity of this cost that we find, search cost. So basically, we allow the base search cost that the dealer face to depend on their geographic specialization. And what we find is that basically, if a dealer has a lot of experience trading bonds issued in the same county as a certain bond, well, they are going to have much lower cost in trading that bond as well. So what's happening here, and similar for state and then and so on. So what's happening here is that, again, what this pattern suggests is another evidence of the presence of this network effect. The idea is that when the demand is very local to the tax advantage for municipal bonds, which means that if a dealer has a lot of clients in the county, it's going to be much easier to call them and tell them, listen, there is a bond issued in the same county, you may want to take a look at it, and that's much easier. Now, what are these network effects? On the vertical axis here, we have the marginal cost as at 0 again. On the horizontal axis, the client network, the trading experience. And what happens is that complex bonds, if you look at the trading experience equal to 0, complex bonds have are associated with higher search frictions because that's what we estimate. However, as you increase trading experience, this complex bond, the search costs associated with this complex bond fall much steeply. So what's happening is, and so, if you are a very experienced dealer, it's almost easier, it's likely easier to sell these complex bonds. So why this picture is very important? Well, this picture is very important because the average dealer has experience equal to 3. So it's here, right before the two curve cross, and the average dealer has experience equal to 8. So right after the two curves cross. Why this is interesting? Because it tells us that the underwriter, by packing the bond with a large number of the special attributes, is able to increase search frictions or search costs for his competitors and decrease the one that he's facing, which suggests where the distortion, the potential distortion comes from. This explains why dealers have, much higher search market share for bonds that are associated with a large number of these special attributes. So what happens if you mandate standardization? You should look at the yellow one, because I haven't told you anything about the interest, the coupon rate. Well, what happens is that investors very happy because all of a sudden, and their welfare on average increases by 2%. They're very excited because because the market is much more liquid, search friction are lower. The underwriter suffers because all of a sudden they find themselves playing in a leveled playing field. What's interesting is that on average, the government suffers because they benefit from the flexibility afforded by the special attributes. Now, I think that this average result for the government is a little bit misleading. And the reason is that, so here we plot it on the vertical axis, the change in welfare for different issuing government. On the horizontal one, the coefficient of variation for government revenues. And you see that the decline in welfare is really associated with these, small issuing government that have very volatile revenues. This is not surprising because if you have volatile revenues, you are going to need flexibility. The governments instead who have revenues that are less volatile instead benefit from the increase in the standardization because they can withstand the pressure of the underwriter to pack these bonds with a large number of special attributes. So I made it to the end. Hopefully you made it too. The paper gives empirical evidence, and market institutions suggest that the underwriter and government official rent-seeking behavior increases the prevalence of bonds with special attributes, and that they benefit at the expense of taxpayers and investors. Using our estimated model, we quantify the extent of these inefficiencies. And this is just the beginning. We are working on more counterfactual. So any suggestion you have about it was very, very welcome. And let me end here, thanking you all for the attention. And that's it.
Right, so I think our discussant will be Burton.
Can you hear me okay? You hear? Okay, let me. Can you see that okay?
Yep, we can.
Okay, so thanks a lot for asking me to discuss this paper. Before I get going, it's really terrific. The paper is still early, so that makes it fun to discuss, but I'll say it now. I think there's a huge amount of potential here. It's asking some important questions. The methodology seems pretty impressive to me, and I learned some new things from it. So, what else could you ask for? So in my discussion, I'll try to explain what's going on here. I'll do that fast because the presentation was very good. And then I'll just have some questions and some things I was puzzled about in the paper. Okay, let's see if I can get this thing to work. Okay, so let's maybe set the stage. As Julia said, about half, maybe over half the bonds in the muni market are issued through negotiated underwriting. And what that means is the underwriter is chosen, and then they help you decide what to issue. Sometimes even they help you get the project passed, because for some of these projects, you need to get voters to approve the tax increase that's going to pay back the bond. So even if you are worried about what they could do, I think they can do a lot. They can really help with things going on. And I think it's important that they can help you with the projects, because actually some of even these bond features might be determined by the rules of, you have a 30-year project, you have to have 30-year bonds. So there's a lot of scope for what's going on in this paper. And here's what we know from the literature already, I think, is if you just compare yields, like a super simplistic cost measure, underwriting through negotiations versus the other big method, which is competitive underwriting, where you pick the bond, then sell it, it's about 15 basis points higher. So that's already pretty expensive. What seems always puzzling is if the government was trying to minimize their financing costs, if you look at the data, where it's possible to use negotiation, people want to use negotiation. So somehow the issuers kind of think it's an important thing to do. So, you know, the question we might be asking is, are they wanting to do that because there's value added from the negotiations and we're looking at the wrong counterfactual? Is it because the people who are making the decisions aren't necessarily trying to minimize the costs to the government? And the contribution in this paper is to find another source of variation to allow us to kind of make some headway along those statements. So that's one contribution here. The exogenous variation they have is pretty nice. It showed up in that nice LinkedIn picture that we saw in the presentation. Lots of people who make the decisions, there's kind of a revolving door, and we've heard lots of discussion about revolving doors for maybe people who are making decisions in government and other contexts as well. And so in the muni market recently, they essentially in some states and in some areas, they banned the revolving door. And so that's the exogenous variation. And we can look to see how the complexity changed. So conditional on negotiating, how do the bonds change? And that's new because the literature has always just kept basically the bond characteristics fixed. And I won't go through it, but there's lots of compelling, maybe what I'd call regression or causal evidence that this really did reduce the complexity of bonds and reduce the costs. So that in itself is a contribution to this literature, actually. But there's a lot more in the paper. Okay, so what do they do? And I think maybe that's why the paper is in this conference, is they take seriously a search model, and they're going to look at another mechanism that could cause problems. So what we're going to do is we're going to structurally estimate how the trading works, how the underwriter issues the bonds, and how much money they can make on trading. We already know that you make a lot of money being a dealer in these bonds if you get the share, if you get the trades. Now we're going to see what does the ability to be an underwriter who chooses the bonds and makes the bonds kind of maybe split the market in a new way, how much extra value there is for that, okay? So we're going to structurally estimate a version of SaMMF's paper, which allows for endogenous quantities, which you need in a market like this, which allows for endogenous search effort by the dealers. And we're going to estimate this. It's on my later slide, but this seems pretty impressive to me, bond by bond, as if I understood this right. And then with this bond by bond thing, we're going to combine that with the exogenous variation from these rule changes to see this channel of bond characteristics. Okay, so again, maybe just to repeat a little bit, this is interesting for the bond market, but there's lots of situations where some intermediary picks the product for you. I think we can all think of lots of them. Getting your mortgage is another example. You know, what cell phone to buy, I guess, has some of this in there as well. So this is a bigger question than just about the bond market, okay? And then we'll use this to learn about the agency issues within the government, some of the restrictions or some of the information about how trading technology is working in this market and how much internalization is going on, okay? So here's in like a couple minutes how this model works. I'll try to be really quick on this. It's a model where the characteristics of the bond, which are going to be endogenously chosen, determine the valuations of the investors. So that's the benefit of kind of this characteristics choice. because you could have benefits from it because it's a better product. That's important, I think, for the story here. Then the dealers, at least the underwriter dealers, choose their search speed. And the benefit you're getting from being an underwriter in this model is not only can you sell the bond, but really like the way it works in the market, in secondary trade, you make money if you know who wants to buy the bond. You don't really make so much money buying the bond from somebody else. You have to have the counterparty in these markets. So that's, and if you talk to traders, they do mention, if I'm going to sell the bond, I'm going to go to the underwriter first because he knows or she knows who to sell it to. So that seems plausible to me. And so again, something pretty cool. They estimate this bond by bond. That was step one in Julia's discussion. Then they take those fitted parameters and they basically project them onto the bond, these endogenous bond characteristics, and use the exogenous variation from the instrument to see what's going on. I think that's what's happening here, okay? Then we plug in the value function from this USLA model that's giving you the value to the underwriter of the bond. It's, you know, his present value or her present value. We plug that into their payoff function and estimate by matching basically the choice probabilities on the characteristics, as far as I could tell, to get the payoff functions of the two people and to get kind of the valuation and the bargaining weights. So I think that's what's happening here. So now how are we getting agency in here? There's two ways that the kind of government workers are dealing with agency costs. One is that, I guess A is the par value of the bond. 1 plus RT must be the future cash flows. And so the second term here is some kind of measure of the present value of the bond's cash flows. C is some kind of misvaluation that the government has. So if C is low, I think the way you should interpret that to mean that I just promised to pay you $100 billion, but it's only worth 1 billion to me. I guess that's what's going on in this model. Now, C doesn't have to be 1. When I teach bond math, I guess I wouldn't use this formula, but it seems pretty good, seems good enough to me for what we're doing here, okay? Then also, and I think this is to capture some of the old stories in the bond market where before they were doing regulation, there was some evidence that the underwriters were like basically bribing people. So in the payoff function of the government employee, they can capture a fraction of the payoffs from the issuer. Okay, so that's how underwriting works. And we're going to take the data. We know the value function of one person. We know the choices. So we're going to try to infer these parameters from some kind of moment matching exercise. Okay. So I just, in my remaining minutes, I wanted to say a few minutes or say a few things about the data and like questions I had that I think might be useful to put into the paper. Okay, so the plot there, it's not super relevant to this paper, but it does have some information. So this is for a particular bond that actually turned out to be one of the ones with the revolving issues. On this axis, we're plotting the aggregate inventory of the dealers. The first point here is actually the day the bond was issued. The data I have doesn't have the dealer names or the underwriter, so we just did the aggregate for this. And I think the reason I wanted to show you this was just a couple features about this market, why you think this model would make some sense. So for this particular bond, it's from Mariposa County in Arizona. On the first day or so, they sold 4.1, I think it's million of par. And then that's it. And then a few days later, the aggregate dealer sector actually bought it back. So there's some kind of flipping going on. So that's the quasi dealers we were talking about earlier, I guess. So the dealers get from clients and then they work down their quantity, and about 2 months after the thing, we're back at some steady state level of dealer inventory, and there's a few little pulses as somebody who owns the bond decides I want to sell, and it gets in the dealer system and out of the dealer system. So what this model is about is it's going to be taking this, as far as I can tell, this whole curve and trying to fit a non-stationary bargaining model for that. So maybe my first question is that what you're doing, actually? So there's a lot going on here, right? There's multiple people trading. There's underwriters who basically know who the bond goes to in this first day, and the model is set up so that their costs go way down for further search. And the idea is the more complicated the bond is, the more that underwriter can gather from doing this. And so that's when I thought my slides say dynamics from network. That's what I mean. And so we're going to try to estimate that effect. The other thing that's also true in—
I hate to cut this off, maybe one more minute or so.
Yeah, perfect.
Great.
I'm right on track.
Wonderful.
So the other thing you see in these data is if you look at the price dispersion of the bonds day by day, historically, I don't know in your data because I haven't looked at it, but historically what you'd find is early on, you find the big people and you sell the bonds to them, the big quantities, and they get a good price. And then over time, the dispersion in the price, even during the issue period, starts to widen, which is a sign that you must be searching for people in this model. And so actually a question I have about your estimation is how much of this are you able to capture? And what information is in there? Can you explain how this is working? Because it's not so obvious in the paper. And so here are the things here's the big question I have about this paper. And it's the second and third bullet points on here. How much of that underwriter value function is coming from the initial 20 days of trading the bond versus the future? I think that was kind of related to Zach's question earlier as well. And how much of this kind of problem is coming from early versus late? Because it seems like that's really important, because if it's not really coming very late, I'm not so sure how strong the mechanism you have is. And that's what would convince me about what's going on here. Then I guess I just wanted to say some things. This agency cost seems huge to me. I issue a bond that costs me $100 million, and I value the cash flows at $60 million. If I'm understanding those things right, that seems awful big to me. It is kind of cool, I guess, that the Republicans care more about the payments, but I would like to understand a little bit the magnitudes. And then the last point I'll make, and then because I'm out of time, is there's a couple counterfactuals. The paper I saw didn't actually have the numbers in it yet. I would like to see the counterfactual as to see what would happen if you just banned negotiation in the first place. You just said they all had to pick the bond and then find an underwriter. You still could have some customization, but it would be less. I think that would be a nicer counterfactual, because that's what they've done in many places. So I'm going to stop and just say I think this is a paper with a lot of potential, and thank you for letting me go over for a minute or two. So thanks a lot.
All right, thanks a lot, Burton. Julia, you want to take maybe just a minute or two to respond, and then we could open up in the remaining time for other questions.
Yeah. So thank you. First of all, thank you for reading the paper, very carefully, and for all your comments. And it's extremely useful. Let me just say a couple of things. First of all, one piece of data that for us was very important at the very beginning is that the underwriter trades 3 times as much the face value of the bond in its lifetime, which suggests that it's actual secondary trades, so not just the selling of the bond, are actually a driving force of their profits. You are right that, so in terms of the dynamics of it, we have been thinking a lot about, there is this very clear pattern where basically trade for municipal bonds happen at the beginning and the end of their lifetime. And so, right now we don't have a model that explicitly want to capture that. However, we see it because of the, finite time horizon, we see exactly that, that shape in meeting rates, but not as much as we actually see in the data, which, we are thinking of having valuation changing over time as an example to capture that moment. In terms of the dispersion of prices, I think it's an excellent point. We do have a lot of heterogeneity built in the model, meaning that we have heterogeneous valuation for investors, and on the dealer side, heterogeneous cost. So basically, the search costs differ across dealers. So we are going to see some of what you are mentioning, but we never looked at we never looked at how well we are matching it, and I think it's an excellent point. I think that's it, and I think maybe Karam wants to add something. But yeah, thank you, and I think we'll bug you more maybe in the next days. Yeah.
Great, so we have time for some questions.
Julia, can I ask you a question? Does the network benefit persist forever in the model? As in, does the underwriter become the market leader and stay the market leader? And does that match with what you see in market shares over time? Because that seems like it would be important for whether dealers who aren't the underwriter benefit from complexity or not.
Yeah. So I haven't looked at this exactly. We do see so, but just looking at the trading experience, even if you look at the highest, in the lifetime of a bond, and you compare the underwriter with the other dealers, the numbers are basically the trading network of a dealer is almost 2 or 3 times as large as that of investors, and even our estimates. These translate to a substantial and enduring cost advantage. We do not allow something which we do not allow, and we may add to the model is something like you build experience, but you forget, right? So we have, we have learning by doing, but not forgetting by doing. So experience, once you trade it with an investor, it's going to be part of your network forever and ever. And we may try to think, about having a little more general model, even only for robustness, where we allow some amount of institutional forgetting and try to estimate how big that is. Yeah, so I think we could do that.
Right. Yeah. So when you, all right. So the choice of complexity reminded me of. It's altogether very different, but Guido Menzio has this paper where he shows how when search friction decline, producers might have incentive to differentiate horizontally more or to escape competition. And I was wondering if, that sort of effect could be looked at using your model, for instance, in relationship to in the transparency enhancing measures in the municipal bond market. So the idea is that there would be an unintended consequence of more transparency, which is an increase in complexity, and maybe that mitigate the possible reduction in transaction costs and things along those lines.
I mean, yeah, so in the paper we don't explore that because we don't want to deal with incomplete information, which is, but I think we have been talking a lot about this, and maybe this is something that we can explore in the future. But that's exactly so. When I present this to a IO audience, I always mention that this is basically a paper about obfuscation. So exactly what you're mentioning, yeah. So thank you, yeah.
I have a related question about information friction. So if is it possible that, say, municipal bonds with a lower rating is more likely to have more complicated or more customized features, which might indicate that maybe the dealer may have some advantage in their information about the bond quality. That will also affect the transaction costs in the secondary market.
So let me think about it 1 second. So again, so you're saying they have more. So if the bond is more complex, they have some sort of, the underwriter has some sort of information advantage about what it actually says, and therefore,
I just meant there may be something else, say, that affects transaction costs when we look at municipal bonds with lower rating. But if you focus on higher quality municipal bond,
yeah. So
okay.
We can definitely do everything. We could look at some heterogeneity, especially in the motivating evidence by rating. Although it's tricky because that's also endogenous. But we can think of of looking at that. And one thing that you exactly right is that we don't really think about incomplete information in this setup, and basically this type of effect would basically that you are describing would be loaded up in our estimate for the search cost, I think. Yeah, so you're right. We can do a little bit more about that. Right now, we don't have it in the model, and I think it just loads up in the search cost that we estimate. Right, Carol?
Yes, we also control for government finances. So the reason that we didn't include the rating is it is potentially endogenous variable. So the complexity itself can affect the rating. But we agree that there are many other factors that can affect search frictions itself. Any more comments you would like to include more in there? But we put a lot of attributes to government and the bond attributes itself, like a revenue bond or geo bond, things like that. Thank you.
Okay, I guess it's time to move on to the next paper. And thanks everyone for staying with us until the last paper on the program. So Michael Choi is gonna present the foundation of the market power in monetary economics.
Hi there. The screen is okay? Okay.
Yes.
Thanks. So thanks to the organizer for having us here. Very happy to talk about this new project. This is joint work with my colleague, Guillaume Rocheteau. So the motivation of the paper is to think about market power. Market power itself is a tricky notion to define, but clearly very important in studying all kinds of important issues like pricing, misallocation, growth, etc. It's important both in micro and macroeconomics. It's also kind of a timely topic because a lot of empirical work have been saying that there's an increasing markup and concentration in the US. So people worry that market power is increasing in the US as well. So the goal of this paper is to try to get to its root from first principles. So we will have a theory about market power. I will be a lot more specific about this. As you will see, at the end, the key idea of the paper is that financial and search friction are going to shape the economic rents in the model, and the sellers are going to invest to seek these rents. So the idea here is very similar to the standard idea in the OTC market models. So many people study market power before. We are not the first. Our idea of market power is consistent with this quote, for example, by Philip Pond. He mentioned two things. Market power, first, it measures firms' ability to extract surplus or profit from consumers. And second, it matters whether these consumers have readily available alternatives. So the outside option also matter. So we're going to build a model, try to capture both of these two components. Our approach is the following. We first will provide a theory of markets in a monetary economy. So we're going to follow the game theoretic approach pioneered by Rubinstein and Wolinski. So should be familiar to all of you about search and matching and then bargaining. So naturally, prices and allocation are going to be formed through the interactions, and we're going to be explicit about how the trade surplus are formed under various kind of friction in the market. In the paper, a lot of the analysis, the underlying idea, we are thinking about a goods market between producers and consumers. So some might worry that the Rubinstein and Wolinski approach is not realistic because we are using bargaining. We also work our version with price posting. If I have time, I'm happy to talk about it, but most of the talk, I'm going to cover the bargaining version of the paper. It's also going to be a theory of conflict. The bargaining share by the producers are going to be endogenous. They can invest to increase their bargaining share. And the consumers, they will have the outside option during the meeting to look for other producers. So you can just walk out of the shop if you don't like the deal. And these two tensions will at the end pin down the share of surplus go to each side of the market. The so wait, I'm missing ones. Yep, here. So the mechanism of the model can be summarized by this picture. When a buyer and seller meet, they gain from trade as represented by the area between the consumer's demand curve, the red line, and the producer's supply curve, the blue line. This is going to be a model with financial frictions. So the consumer have to pay with money in the model. If you don't have enough money, you don't get to buy up to the efficient level. So there will be some deadweight loss as captured by the liquidity constraint, the vertical line here. The remaining gain from trade, part of it will have to be used to compensate the consumer's outside option. So the consumer don't go to look for other deals. The green area is the surplus that is going to be split between the producer and the seller. So that's the economic rent. The producers are going to have opportunity to invest in certain technology in order to extract a larger share of the green area. Our notion of market power is going to be the share of surplus or rent that goes to the producer divided by the total area between the demand and supply curve. So the total potential gain from trade. A lot of the exercise is going to be about when will perfect competition happens. Our definition of perfect competition is going to be the case when there's no more rent left in the market. So the green area completely collapse, or you can say the outside option and the liquidity constraint collapse to the same line. A large part of the exercise concern, we're going to take the search friction to be vanishingly small and check whether the rent are going to vanish or not. So it might or might not, I will go into the details. So that's the idea of the exercise. In terms of results, there are two sets of results. The first set is we find that with a combination of endogenous rent seeking and endogenous outside option, we're going to have multiple equilibria. The channel is such that suppose the seller increase the rent seeking effort, naturally it's going to reduce the consumer's outside option because now looking for one additional seller is not as profitable. So outside option drops. Now, if you come back to this picture, suppose the outside option drops, so the purple area becomes smaller. Now the green area is going to be bigger, so there are more rents to seek. So the producer indeed have incentive to increase their rent seeking effort to get a larger share of the green area. And that creates the multiplicity. Oops. Yep. Now, because of this multiplicity, there could be, of course, multiple equilibria that converge to perfect competition or not converging to perfect competition. Indeed, we show that as search friction vanish, it's possible the multiplicity persists. And although there will always be one equilibrium that converges to perfect competition, it's also possible under some parameter value that you never converge to such a good outcome. So vanishing search friction might not benefit consumer. It's possible. The second set of results concern the financial friction in the model. We show that, so one observation is that in the standard new monetarist model, that's the workhorse model that we use to introduce money, actually don't have meaningful outside option for the consumers. And because of it, those kind of model, if you take search friction to 0, you don't actually go to perfect competition. But because we introduce endogenous outside option in a specific way, it's possible to get the perfect competition outcome again as search friction vanish. And because of it, we think the outside option is really a key channel to talk about how monetary policy might affect market power. We show that as you increase the inflation rate, you will have two effects on market power. First, it will tighten the consumer's liquidity constraint. That's almost mechanical and is standard in many models. The new channel here is that inflation also hurts consumers' outside option because now carrying money is more costly. It's almost as if you increase the search cost for the consumer as you increase inflation. And because of it, outside option goes down. So the monetary policy can affect market power through two channels, and turns out they're opposing each other. So the overall effect is going to be ambiguous. So this is the preview of the results. Very quickly about the literature. Again, we are following the Rubinstein-Wolinski approach to think about markets. Our notion of perfect competition, where when vanished, is first introduced by Ostroy and co-authors. We are following the tradition. The way we introduce money following the standard new monetarist model as exemplified by Lagos and Wright, we are actually using a continuous time version of Lagos and Wright that is based on my earlier work with Guillaume. Continuous time is not a big deal here. It just makes our life easier when we take the search friction to 0. The notion of rank seeking is introduced long time ago by Truelove and Kruger. Schilling applied it to study conflict among countries. In the money literature, Moschetta and Wright tried to endogenize it with directed search. Neil Wallace has a paper to survey all these opposed to use mechanism designed to endogenize the rank that goes to each side of the market. Our approach to model rank seeking is similar to this paper by Fabodi and co-authors, which indeed apply the idea to OTC markets. But because of the specific setup and application, a lot of results are different. But some of the idea about multiple equilibria, those things are related. Okay, let me jump to the model. So this is a continuous time environment. There are two types of agents, a unit measure of buyers and a unit measure of sellers. There are two types of goods in the market. There's a good Y that's being traded in pairwise meeting. So this is the good that's being traded in this Rubinstein-Wolinski model. Because we introduce money, we adopt the Lagos and Wright framework. So we also have this centralized market good, which is denoted by C. We are going to use it as numereware. So the market is going to work as shown in this timeline. So at some Poisson rate alpha, agents are going to enter some pairwise meeting where they bargain and trade. Sorry. Immediately after the meeting, they have access to the centralized market to restock their money holding. So they always carry the optimal amount of money that they want to get ready for the next DM meeting. In this example, there are 3 meetings, but it doesn't matter. It just happened at some Poisson rate. Okay, so it's really similar to the standard Lagos and Wright type of model, but here it applies in continuous time. Yep. So in the pairwise meeting, there are 2 possibilities. One is it's a money meeting. You must use money as a payment. Otherwise, it's a credit meeting. You can borrow and then we pay later. So money is not a concern. Money in the model is a fiat object, useless intrinsically, storable, durable. And the supply of it is empty and it grows at a weight of pi, a constant weight of pi. We will play with the weight pi to see how it affects trading outcomes. the value of money is VT. And as in standard new monetarist model, the new money are going to distribute it to the agents through a lump sum transfer to the buyers. Sorry. When the agent meets, they're going to bargain. They're going to bargain according to the Carlyle bargaining protocol, which turns out is very similar to Nash, but with some nicer properties for studying monetary economics. For this talk, you don't need to worry about the details. All it matters is that the Carlyle bargaining is going to split the surplus according to a fixed share of mu. So mu is the bargaining share that goes to the seller in our setup. Guillaume's earlier work with Carway Hu provide micro foundation for this kind of Carlyle bargaining. Now, one key innovation of the paper is that the bargaining share mu is going to be endogenous. Oops, wait. Okay. So the way to endogenize the rent-seeking effort is the following. The firms have to pay a full cost V of mu in order to maintain a bargaining share of mu. Mu here is an increasing and convex function. So what are some examples of these rent-seeking activities? So you can imagine the firms are hiring consultants to better negotiate prices or negotiate a deal with the consumer. So you can invest in consultants, or you can just like all these sellers like Amazon. You can invest in big data to learn about your consumers' demand. There's another way to extract surplus from consumers. In fact, Guillaume and I worked out the extension that exactly do this. So the firms can invest and to learn about the consumer's demand in the extension. By investing in the learning the demand, you essentially change from second-degree price discrimination to first-degree price discrimination. So you can better extract surplus by doing better pricing. So we have a version with that thing worked out as well. The main result also go through under the extension. You can also imagine the firms investing in the ability to increase marketing effort or to lobby a better deal to make the law on their side. So all these are examples that we have in mind that can increase mu.
Michael, can I ask a question?
Yeah,
Ben, sorry.
please.
So I came a little bit late to the intro, but I thought the idea was to kind of derive these sort of rents from first principles here. But now we're jumping right to like a reduced form expression that just tells you, like, to some extent how much market power you have. So like what? But I'm missing something clearly. So what am I missing?
Yeah. Okay. Did you see that picture about this picture? Yeah. So
yeah, I saw this picture. Yeah.
Yeah. Okay. So we think up to this point we are micro-founding how rent is formed. So the part that I just talked about, the firm can invest in getting a larger share of the rent, the green area here. You can say that's a little bit like a black box because we haven't specified which technology or exactly what's the mechanism. You can get a larger share of the green area.
Okay.
But like I said, we work out an
So you're gonna, is it fair to say then you're gonna think a lot about the micro foundation of why there's a green area and not so much about how much goes to each one? Okay.
Yes. Well, we have something to say about the latter as well, but not as much as the former. Yeah.
Okay.
Yep. Okay, so that's the model. Now let's see the results. So in the pairwise meeting, the agent are going to negotiate the amount of output Y and the production and the payment P. So according to Carlyle bargaining, the payment to the producer is going to be sorry, at least first compensate the producer's cost of production. In our model, it's just linear. So to produce Y unit of good, it costs Y unit for the producer. So we have to compensate the production cost, and then a fraction mu of the surplus. So utility of y, u of y is the utility to the consumer minus the production cost, that's a surplus. A fraction mu of it also have to go to the producer. In the credit meeting, we will just produce up to the efficient level. So y equals to y star. In the money meeting, you either produce up to the efficient level or you produce up to the point that the consumer's liquidity constraint is binding. So all this is standard in the new monetarist tradition. Now, one thing about how to think about market power. So in a larger model, people tend to think markup is a good measure of market power. And usually the reason is because in the standard monopoly problem, if you solve for the optimal markup or the markup posed by the monopoly, it corresponds to 1 over the elasticity of the demand curve. And the elasticity of demand curve have some natural appeal to represent market power. So because of it, people tend to use markup as a measure of market power. But in this class of search and binding model, there's no such foundation for markup. So instead of using markup, we use something called the market power of a seller, MPS, which essentially is just a fraction. On top, we have the fraction, we have the seller surplus, so the blue area in these pictures, divided by the total gain from trade, which is the area between the demand curve and the supply curve of the agents. So in these two pictures, in the left panel is a money match. So you only produce up to what your money holding allows you to produce. So YM is what is the production in this money match, and then we split the surplus according to a fraction mu goes to the seller, otherwise go to the buyer. In a credit match, you produce up to the efficient level, but you split the surplus just the same way. One thing to notice is here, the MPS, the market power measure, increases in mu. That seems intuitive. And it also increases in A star, the amount of money the agent carry. That also seems natural because if you have more money in the match, seems like the seller have more ability to extract surplus from the match. It turns out if you use markup as a measure, markup is not increasing in A star. So it actually gives you some counterintuitive predictions.
Michael, does this mean that in a money match, the market power of the buyer and the seller would sum up to something less than 1? Is it?
Yes, yes. Because it's a fraction. Okay. Yeah, you're right. It's constructed that way. Yep. Thank you for pointing it out. Yeah, so 0 will be no market power for the seller. 1 will be all the market power goes to the seller. I will only talk about 2 Bellman equations very briefly. So 1 corresponds to the buyer's money holding decision. The cost of carrying money in this model is I times A star. A star is the amount of money you carry. The opportunity cost here is that you're subject to discounting. So rho is the discount rate, R is the rate of return of money. That depends on the inflation rate in the market. If you carry more money, it benefits the buyer in the money meetings because now you get a larger output. It doesn't matter in the credit matches. The seller's rent-seeking effort solve the following equation. The cost of rent-seeking is V of mu, and the benefit of it affects both the money matches and the credit matches. You get a larger share out of both matches. So the direct effect is that you get a larger share. This is almost similar to, for example, search intensity. You get a larger probability of matching, very similar in terms of idea. But here, if you increase the rent-seeking effort, you also affect the terms of trade in the money meeting, because now you get to produce less output for the same amount of money income from the sellers, from the buyers. So you also affect the intensive margin as well. Okay. screen is not responding so well. Okay. So with those two Bellman equation, you will pin down two first order condition, and turns out there will be you can derive a unique steady state. And this steady state, if you increase the inflation rate, make money more costly, you will reduce the gain from trade in the meeting. And because of it, you reduce the seller's incentive to rank seek. So mu will be smaller. Also, the market power will be smaller because now mu is lower. It turns out in this particular version, the optimal monetary policy is I bigger than 0. So you want to tax people's money holding a little bit, for the reason that by taxing money holding, you reduce the wasteful rent-seeking activity, which is not desirable by the planner. And turns out the distortion by reducing gain from trade is second order, but the gain from reducing wasteful activity is first order. So we can show that Freeman rule is suboptimal. Now we do the Rubinstein-Wolinski exercise. We take search friction to 0. As we take alpha to infinity, you meet instantaneously. There are two possible outcomes. It depends, which outcome arrive depends on the marginal cost of rent seeking evaluated at 1. So if that marginal cost is small, you will have the producer choose mu equals to 1, so they seek all the ranks, and output will be lower than the efficient level. Otherwise, output will be efficient, but still the producer will seek some rank. In both cases, no matter which one happen, you never have a perfect competition outcome, in the sense that there will be always rank, and there will be always rank seeking. So mu is strictly bigger than 1. This is going to correspond to what happened in all kinds of new monetarist model. As you take search friction to 0, you will always have some rank left. Why? It's because in this particular version, as I increase the matching rate to infinity, it doesn't really help the buyers in the bargaining. It's because here, no matter what you do within the meeting, you're going to trade with future producer anyway. So no matter I accept the trade or not accept the trade today, I'm going to trade with the same behavior in the future. So even if I can meet people very quickly in the future, it doesn't help my bargaining. Nothing happened there. In other words, the opportunity cost of accepting a trade is 0. It does not depend on alpha. So in these kinds of, so our observation is that in a standard new monetarist model, having a high matching rate doesn't really help the bargaining. One analogy we make is, if you are a customer that's always hungry, then meeting with restaurant really quickly doesn't help you to bargain with the restaurant owner, because no matter you eat the meal today or not, you're going to eat another meal immediately anyway. Versus if you can only eat one meal, okay, then eating the meal today is really costly in the opportunity cost sense. So if you have unit demand, for example, then meeting with other sellers is really beneficial for bargaining, otherwise not. So that's why we think outside option doesn't really enter the standard new monetarist model in a meaningful way.
Michael, just a reminder, you have 4 minutes, and
okay.
Shangjin, please
okay.
go ahead.
Sure.
I'll wait for.
Yeah, okay, I'll finish it. Now, the remaining task is to introduce the outside option back in a meaningful way. The way we do it is to say there are 2 types of buyers. You're either active or idle. So you're either hungry or not. If you are hungry, at some Poisson rate gamma, it will become not hungry. So that's exogenous. Or if you trade with certain producer, then you also become not hungry. If you are not hungry, then at some exogenous way, you become hungry. So that part is mechanical. Now with this setup, the bargaining becomes, okay. Now in the trade surplus, have to subtract the outside option of the consumer. So here, VB is the continuation value of an active consumer, and WB is the continuation value of idle consumer. So the difference is the outside option in the bargaining. So now CB here is represented by the purple area. Okay. So now in the bargaining, the gain from trade must at least compensate the consumer so that the consumer don't continue to look for another producer. And the remaining gain from trade will be split according to mu. In this version, we are going to have multiplicity, as I discussed in the beginning. If the seller invests a lot in rent seeking, it worsens the outside option of the consumer. It will increase the size of the rent, which indeed increase the producer's incentive to seek rent. Now, what's the implication of this multiplicity? I'm going to show you two examples, and then I can wrap up. So the first case is, suppose the marginal cost of rent seeking is very high, so it's costly to seek a lot of rent. Now, in this 6 panel, we plot various endogenous variables, and the x-axis is the matching efficiency, alpha. So if the matching rate is low, there's a unique equilibrium as represented by the blue line, and the rent-seeking effort in this equilibrium increases. Okay, and when the matching efficiency is higher, there are 3 different equilibria. And at the end, as I increase alpha to infinity, turns out only one equilibrium survives. That's the equilibrium that corresponds to perfect competition. There's no rent seeking at the limit. So this is one possibility. The other possibility is when the rent seeking effort, the marginal cost of it is not too large. It turns out in this case, you can have multiplicity even at the frictionless limit. So when alpha is small, again, there's a unique equilibrium correspond to the blue line. If you follow this equilibrium, as alpha explodes to infinity, we will actually stay at this equilibrium and mu goes to 1. So all the rents go to the producer. Consumer get no benefit. The good equilibrium, the green one, exists, but we might not get there. It depends on the coordination among the agents. So I'll skip the proposition, which is just what I said in a more formal way. The lesson that we take out from the exercise is that at the frictionless limit, there always exists an equilibrium that converges to perfect competition. So reducing surge friction can potentially do good for the agents. But it might not happen. It depends on the coordination. And the main idea is that as you reduce surge friction, of course, it helps the consumer to have better outside options. So it's good. But the producer also think it's easier to meet another consumer. So it's more effective to seek rent. So the producer also have more incentive to seek rent and so you reduce surge friction. Now, which one of these two forces win will depends on which equilibrium we are coordinating on. And turns out all these equilibria can survive at the limit. So I have 2 minutes, okay. I will quickly mention. So in the paper, we also do the extension with entry so that we can endogenize the HHI index. Turns out we show that HHI is not a good measure of market power as well. We can also do two-sided rent seeking. Both the consumer and producer can do it. That will introduce another layer of multiplicity. There can also be firm heterogeneity in the sense that you can think of as surge friction vanish, the productive firm will earn a larger and larger share of the market. So the HHI will drop. Sorry, the concentration will increase, but it's actually good for the consumers. So that related works, I would just mention that we endogenize the V function. So far what I present is the real V function of rent seeking is a black box. We endogenize it by saying that the producer can learn about the consumer's preference. And by doing so, you can change the pricing protocol from second-degree nonlinear pricing to first-degree price discrimination in order to increase profit. So that endogenizes the black box of V as well. Okay, I think. Okay, I think this is the last slide. 1 minute. Okay, I was say that in this exercise, what we do is we try to follow the Rubinstein-Wolinski tradition to talk about how WANs are formed and being split to each side of the market. In addition, we also introduce financial friction to talk about to the Rubinstein-Wolinski framework. The new insight is that monetary policy now affect two margins. It affects the consumer's outside option. It also affects the production within the match. So the overall impact is ambiguous. Another important lesson is that multiple equilibria can arise even at the frictionless limit. So that whether we go to the good or bad outcome, a lot of it depends on the cost of WAN seeking, depends on the functional form of it, and also depends on the coordination among agents. Thank you very much.
Thanks, Michael. So our discussion is Ariel Zetlin-Jones from Carnegie Mellon.
Michael, I think we just have to wait for you to stop screen sharing.
Oh, okay. Okay. Pause share. Help. Sorry.
Let's try this. That's better. How is everyone? Surviving the day. I guess thanks to the BMW of Greater Richmond for getting Bruno home. I see he's left. No, seriously, but uh-oh. My computer's having some trouble here. This is not my standard computer. If this dies, I'll try sharing a different way. Thanks to the organizers for having me, putting together this conference. It's a really nice group of people. It's a pleasure to talk about this. I guess after 9 years of being in Pittsburgh, but leaving Minnesota, I'm still a Minnesota person at heart. So with that, I'm just gonna say, let's get to the model. So if my slides will adjust, there we go. Here's the model in 3 equations on slide 1. I think it's gonna frame kind of all of the interesting action in the paper. So I'm starting with welfare. And what I want you to take when looking at welfare is, so I'm doing this in discrete time. It's like a standard new monetarist model. You've got buyers and sellers. And the buyers in the centralized market are going to pick up some money to be able to go and trade in the frictional market. And after the buyers pick up their money, the sellers are going to make a choice, which is, as Ben and Michael discussed a bit, they're going to choose in a reduced form way to exert some disutility of labor, minus V of mu, to decide their bargaining weight that will be applied in the bargaining protocol in the frictional match. Is that clear? And what's important here is this is pure waste. Okay, you just see in the planner's objective, minus V of mu is a pure cost. All that's doing is deciding how the gains to trade in a frictional match will be divided. What else does the planner care about? The planner cares about conditional on a match, which happens at rate alpha in this plain vanilla model, exactly what are the gains to trade between a buyer and a seller. Okay. Now what's going to happen? Well, buyers have to hold money optimally. So the opportunity cost of cash I has to equal the benefit. What do they get from bringing a little more cash into the market? They, on the margin, they get U prime minus 1. They get a little bit of the gains to trade. And then the denominator term reflects the fact that as they hold more cash, the bargaining protocol adjusts exactly how much trade occurs. So the Y adjusts a little bit. Okay, and so this is a standard equation in any kind of new monetarist model if you use proportional bargaining. What's going to be optimal for a seller? Well, now a seller has to optimally choose their bargaining power. And again, I'm going to focus on bargaining power, not quote unquote markups or market powers of sellers, because it's the clear object in the model. So the disutility on the margin of choosing a little more bargaining power has to equal the gains. What do you get? Well, now you get a larger share of the total economic pie in a match. That's U minus Y, right? Not just the marginal benefit of a little more gains to trade. You get U minus Y, and you get a bit of that. But then again, the terms of trade adjust a little bit. So you get a similar adjustment. And so what this model delivers, which I really like, and I think is interesting, hopefully my highlighters work, is a nice relationship between monetary policy meeting rates and bargaining power. And so all of the results in the paper are about understanding how policy rates that affect I, right, inflation, and the meeting speed alpha interact with exactly what mu's sellers are choosing. And I think that's a way to understand what the paper's doing. They're offering rich links between bargaining power of sellers, monetary policy, and trading speeds. And if you go through the paper and all the different variants and extensions they have, roughly speaking, there are two broad classes of results. One, what is the effect of changes in trading speeds on markups, market power of sellers? Or two, how does monetary policy interact optimally with these markups? Hopefully the policy for my plain vanilla model is kind of clear. I'll erase these. Right? If you focus on the buyer's optimal kind of condition right now, and you look at the standard Friedman rule type logic, you say, okay, well, if I want to maximize gains to trade in frictional matches, I should set I to 0. If I set I to 0, then we'll get U prime of Y is equal to 1. That's optimal maximizing gains to trade. Is that clear? The problem with that is when you maximize gains to trade, these sellers are going to choose wasteful kind of market power, so to speak. Okay? And then you have an envelope condition from optimality, right? That says, well, if I distort terms to trade in a frictional match a little bit, those are second order losses, but I get a first order effect on this wasteful rent seeking that our sellers are undertaking. So that's why the Friedman rule is not going to be optimal. So the monetary policy stuff is very intuitive and follows just from understanding these equations, and it generalizes in lots of ways. And I think Michael did a nice job of describing this, right? That as you distort the amount of money buyers bring into a match, you distort the size of the economic pie between a buyer and a seller. And as you make that pie bigger or smaller, that affects sellers' incentives to take a larger share of that pie. Okay. So now what else do they do? And I want to focus on trading speed because I think it's a little closer to the OTC market interpretation. They have lots of generalizations. My plain vanilla model only had cash meetings. They have cash and credit meetings. As Michael emphasized at the end, they endogenize these buyers outside options. I'm going to talk about that in a minute. They think about entry of sellers and market concentration. They think about selection of sellers and market concentration, kind of who's entering these markets, if they produce different qualities of goods, all these different features to try to understand how trading speed and monetary policy interact with markets. Okay, so it's a rich paper. Obviously, I can't talk about all of it. I'm going to focus on the outside option result and try to gain some insights here. So what's the idea? We're going to add to my plain vanilla model that buyers face an opportunity cost of accepting a frictional good. So when a buyer and a seller meet, if the buyer accepts the good, effectively they give up the option to consume the frictional good in the future. And I think Michael explained that clearly. Okay. So this means there's a loss, right? In like a DGP world, this would be like you've accepted the good and now you have an inventory constraint. You can't be a buyer again in the future. That's what that option value is going to represent. But we know in bargaining solutions, gains to trade depend on your option value. And so now they've introduced a meaningful option value to the buyer, okay? And as gains to trade affect those option values, that affects the size of the pie that can be split between the buyer and the seller. And therefore that will affect the seller's interest in acquiring more bargaining shares, okay? And now when you think about modifying the trading speed, what you're doing is you're directly distorting the option value of the buyer, which directly distorts the size of the gains to trade in a match, which will therefore potentially distort seller's interest in acquiring bargaining power. Okay, so that's how you get some interesting rich dynamics here. I'm going to describe this kind of the way Michael did at the conclusion. He almost persuaded me their main result's the opposite of this. So I interpreted the main result in the paper that as you increase trading speed, you get equilibria where kind of seller's bargaining power converges to 1. Mu is the bargaining weight of the seller who's acquiring this. So they're acquiring as much bargaining power as possible. In the middle of the presentation, Michael suggested, actually the interesting result is getting mu going to 0. In the conclusion, he said, even though that exists, you still get these perverse equilibria, right? Where now we're giving buyers rapidly as much as possible the option to trade, and yet sellers are acquiring as much market power as possible. Okay, so the claim here is that as you increase trading opportunities for buyers, you may not eliminate sellers' market power. Why? Well, there's a direct effect. If you increase the opportunity to trade, alpha is the meeting rate, if that goes up, you raise the option value for a buyer, this shrinks the economic pie and should push down sellers' incentives to acquire market power. But the problem is, what are the other sellers doing? If you believe all the other sellers are raising their market power, when the meeting rate goes up, then you get these perverse incentives, right? Because as an individual seller, you're saying, yes, buyers get to meet more often, but all the other sellers are charging taking more of the economic rents. So even though they get to meet more often, the value of those matches is worth less. And because the value of those matches is worth less, you're effectively not raising the option value of the buyers. And that gives the sellers incentives to acquire even more market power. That would be one interpretation. The idea that trading speed confounds market power in non-obvious ways, given we're in an OTC conference, I just want to say this is kind of a common result. Michael said it's common in monetary economics. I want to remind him it's common in OTC markets, right? We know in markets with, say, a finite number of traders, if we speed up trade, you get endogenous interaction with market power. Effectively, say from Vianos or Du and Ju, traders will end up shading their bids more when trading is faster. And so you don't eliminate market power. You don't eliminate kind of price impacts as you speed up trading. So I think there's some connections to be made also to the OTC literature. I'm suggesting that mainly because we're in an OTC conference. My last two comments are more speculative, which is there's a line in the paper about monetary policy and concentration. There's a line in the paper about trading speed and markups. And I kind of want to know a bit more of what the paper is going after in the data. So if you're telling me concentration, I want to know what kind of concentration are you exploring? And I view these as opportunities for the paper. And I want to come back, and I see Michael and Guillaume are already working on extensions on rent-seeking behavior, but I want to suggest some others. So first, this is one of my favorite facts from the last few years. This nice paper by Rossi, Hansberg, Sarga, and Tractor in the macro annual that's looking at distinctions in concentration depending on what geographic region you're trying to look at. So nationally, that's the very top line here, we know concentration's rising. But if we look narrowly within geographic regions, say a zip code, concentration's falling. And the basic story that they want you to think, I believe, is, well, yes, nationally, Amazon is dominating the whole market. But locally, I used to only have one small hardware store, and now I have a small hardware store and Amazon. And so actually, there's more competition locally. It seems like this search model thinking seriously about market power is going to be well attuned to think about one or both of these. And so I'm curious if there are any opportunities here to focus, especially thinking in a buying, selling type of environment with monetary economics, which measure are you going after, and does the search help us understand these better? And now I'm going to completely, I wish we were at 5 o'clock so I could send you all for beers, but this is totally speculative, which is on what is rent-seeking behavior. So here's a picture. I don't know if any of you have heard of Dave.com. It's a robo financial advisor. So banking for humans. It's a robot that wants to bank on your behalf, okay? Now, what's the idea here? You link all of your possible financial accounts into Dave.com, and they can give you advice and do auto investing on your behalf. It takes a long time to link all of your financial accounts to this. You get locked in, okay? Is this rent-seeking behavior? Sounds like it, because once you're locked in, they can exert some market power over you. But they are providing some real benefits to you, right? They're giving me customized, tailored advice. So in other words, that rent seeking is not pure waste, okay? As another example, I'm sure the macroeconomic data says 9 out of 10 of you have gone and shopped for durable goods in the last year. So most of you have shopped for a durable good. Any durable goods site you go to now, you'll see this option. You can buy with Affirm. This is Amazon's payments platform. Okay, you can buy on credit. Amazon is a monopolist. We know this in some sense, but they're using it to offer you better services. So now they're changing the payment services available to you. I have this on the next slide. I would describe this as they're offering credit on demand. So what is that aspect of fintech, if you will? This innovation says you used to have to bring credit to the online shop if you wanted to buy on credit, or you had to bring cash. And Amazon's saying you don't have to do that now. You can show up without credit, and I can give you credit on demand. So in other words, Amazon's using its knowledge of you as a customer to be able to change your payment services. So yes, they're a monopolist in some sense, but they are creating some value for customers. And so my question, and I'm not even sure what results I'm asking, if it's robust or not, because there are a lot of results in the paper. But I'm curious more generally if rent seeking improves customer experiences, does that change the way we think about the trade-offs of markups, trading speed, and monetary policy in this type of an environment? Okay, so a few different ways to think about how lock-in market power is actually changing the nature of goods we can provide our consumers and improving the quality of those goods. All right, and I think it's worth thinking about that and exploring it. I'll just conclude by saying I'm genuinely impressed by how rich and tractable the model is. As someone who seems to write down intractable models that take me forever to solve, like there's a real elegance in this model in how flexible and powerful it is. And I just think there are lots of opportunities to go after some really concrete aspects of the data and try to show what the model can do. And so that's how I'd encourage the authors to kind of work with me. All right, so I'll stop there. Thanks.
Thanks, Ariel. And Michael, would you like to take a minute to reply to Ariel?
Yes. So maybe I can share my screen as well. So the first thing, oops. Okay. Yeah, so the first thing Ariel said about how we think about concentration and how we think about it in data as well. So I didn't talk much about it. So we try to think about concentration by allowing entry into the market. Because this firm are homogeneous, so exercise index brought down to the market share. So, or you can say 1 over the market tightness in the model. So when we do the exercise, what we found is that the exercise index is actually the correlation of it with various endogenous variable is actually can go any direction, can be positive or negatively correlated. The key idea will be it depends on the source of variation. The idea is just the same as if you have demand curve and supply curve, whether price and quantity will move in the same or opposite direction depends on which curve you're shifting. So it's the same idea for exercise, how it works in the search market. So that message basically tells us that using exercise to measure market power is a very tricky idea. You can still use it, but you need to be very conscious about the source of variation you have in mind. So that message, I think, is consistent with what Philip Pons said in his book, but we just model it and derive it. So that's what we think about how to interpret exercise in the data. And other thing Ariel said, I think is a very good point, is about, so in our model, WAN seeking is definitely bad. You seek more WAN, so it's just a redistribution. But can it do good for the consumer, like the example Ariel mentioned? So our version of that idea is, is the following. So the way we try to capture that idea is to have an extension where the bias preference epsilon is the private information. So during the match, the seller is going to post a price P and output Y for each epsilon. And to maximize the expected profit, and the consumer have to trade subject to the participation constraint, so it has to dominate the outside option, the deal. So now the idea will be WAN seeking is essentially the producer investing to learn about epsilon, so learn about your consumer through big data, for example. And if you have better idea about what epsilon is, you extract more information of WAN from trade, but you also produce more. You cater your service better to the consumer with a larger demand. So there will be social gain from the planner's perspective, but those gain will be all goes to the producer. So we have this version try to unbox the black box of the V function. It turns out even in this setup, depending on the cost of learning about the consumer's type, you can still have the exact same multiplicity as I showed earlier. So even at the frictionless limit, there's no guarantee that we will converge the equilibrium where consumer get all the surpluses from trade. So that kind of partly answer your question, but I don't think it satisfies everything. I think your point is much bigger, that market power has the up and downside, and sometimes it's not obvious which one dominates.
Pierre, you have a question?
Yes, I have a small comment. So the both you, Michael, and Ariel noted that the first model is problematic to think about the frictionless limits because there's no outside option. Yes. So I wanted just to maybe interpret that and offer a related interpretation. My understanding of what goes on in the first model is that the reason why it's not appropriate to think about the frictionless limit is that when you increase alpha in the first mode, you do two things at the same time. You reduce search friction, you increase demand. So you make demand endogenous to the search friction, you make people permanently more hungry. It's a bit like what Rubinstein and Walensky did actually, because they kept on replacing the buyers and the sellers and fueling more of them in the market as people traded, because I'm always replacement. You trade, you're replaced by someone else. So if you trade faster in this model, they're replaced by more people. And then you see it's problematic because you change search friction, but you change supply and demand at the same time.
Yeah.
And I think it's the end, you know, I think that's why the second model is the appropriate one. That you want to keep the demand structure the same or supply structure the same and change search friction.
Yeah, thank you. Yeah, I think I completely agree. Yeah. So in the second version, we have some other set of parameters that pin down the demand, and the search friction is only taken care by alpha. Yeah. So again, we don't think the first version is the right one, but the way we do it is we try to follow the new monitors model as much as possible in the first version, and that's what we got. So it turns out outside option doesn't enter in a meaningful way in that particular setup. And then we try to resurrect some of the result by changing the model.
Okay, we have a question from the audience. Shilei New, so we will unmute you and you can ask your question. Okay, it's
Xing has a question.
yeah. Okay, Shangjin, we can continue with you. And
okay, I just wonder, Michael, so when you take the limits of alpha to infinity, and when you show that maybe bargaining power still matter, I wonder if that has any link with the diamond paradox. So because here the matching between the buyer and seller is always 1-to-1. So even if the matching friction is converging to 0 according to diamond paradox, so that you know there's the bargaining friction might still enter in some way. And then if you give some, allow the buyer to meet potentially more than one seller, could that change the result?
Yeah, okay. Yeah, okay, that's a very good question. So let's see. Does the diamond paradox matter here? I see. So I think that kind of corresponds to exactly the first and to the second version of the model. In the second version of the model, the outside option really helps the consumer as you take alpha to infinity. So in the diamond paradox, I think when it happens, the outside option of the consumer is not helping anymore. Essentially, your outside option is so bad that you just accept the deal today, even if the deal today is really bad. So that's the idea of the diamond paradox. That will correspond to, so that will not happen in the second version of the model where the outside option enters in a meaningful way. When it enters in a meaningful way, it actually helps you to do a better bargain within the match. So in that sense, I think because of the outside option, we don't have the diamond paradox showing up. Now, okay, I should even be more careful to say that. I think the best way to say it is in one equilibrium, you have the diamond paradox. In the other one, you don't. So in the equilibrium where all the firms choose to sit when they choose mu equal to 1, you have the diamond paradox happening. Because if the consumer continue to search, consumer realize that other sellers are also choosing mu equal to 1, so there's no surplus in those matches. So there's no point of searching. So in that equilibrium, you have the diamond paradox happening. In the other equilibrium where mu is 0, the green equilibrium, for example, in this picture, you don't have the diamond paradox because the outside option of the consumer helps to bargain. and the rank goes to 0. So I think the better answer to your question is it happens in one equilibrium and it doesn't in the other one. That might be yeah, what's happening.
Okay, is there any other question from the panelists or audience? If not, we can wrap up the conference here. And thanks a lot for everyone, all the presenters, discussant, and the panelists. Brianna, do you have a question?
I was just trying to clap, but I pressed the wrong button.
Okay. Yeah.
Yeah, thanks on behalf of all the SaMMF organizers. Thanks to all the presenters and discussants and everyone for presenting or for participating. Also, thanks a lot to Melina, who jumped on the SaMMF team to help organize the conference. You were a big help, so thanks a lot.